Market closes at 5 Eastern, 4 Central. If you're on the platform on tastylive.com, thank you for joining us. Welcome. Come over to YouTube. Tell us what you're trading, what you think of this continued collapse in oil prices, down another 5% today, as an Iran-Israel ceasefire is announced by President Trump yesterday after hours. You heard that here first, though, of course. The market here continues to move up, with the NASDAQ pushing to fresh highs that we've seen since late February. Same for the S&P 500. Ultimately, gold's down by around 2%. You see the dollar pull off a bit. The headlines weren't fantastic today, guys, but it's a low volume, low volatility type of session as we turn to the charts, with our NASDAQ up at 22,400 or so here after hours. It's a small little dip from where we closed at 4 p.m. Eastern. But nonetheless, Jamal, you're new to the show. Welcome back. You've been gone for the past 2 weeks, so we'll give you more talking time here. What do you make of this after all that's transpired the last 2 trading sessions?
I make of it, well, I mean, is Trump really getting nominated for like the Nobel Peace Prize for? I mean, that's what I saw. I don't know what to believe anymore. I don't know. I see a lot of things these days, guys. I don't know what to think. I really do believe that regardless of whatever the news was, the technicals were telling us that we were going to be higher at some point or another. And they came through, and they showed through, and they showed up in the form of NASDAQ, which is something I've been long for a little bit. As much as I didn't want to believe it, and Chris, we talked about this a month and change ago as this was forming in the chart. I didn't necessarily believe things were going higher based on what was happening currently at that time, but the chart showed that there was a really good chance we could be at all-time highs come the end of the quarter, and sure enough, that's exactly where we are. So, there's a lot of other news. There's a lot of things mixed in here. You could throw in tariffs. You could throw in Iran, Israel. You could throw in the Fed, but fact remains is that we're a stone's throw away from all-time highs, if not kind of having touched it a little bit in the NASDAQ today.
Ilya, we're not quite at all-time highs yet, but we're getting pretty darn close. Surely that provokes a change in your posture.
It certainly does. I mean, my thinking here was we had a high on all of the indexes basically on CPI day 2 weeks ago, and nothing wanted to go anywhere, not on the FOMC, not apparently even on the breakout of a war in the Middle East before all of this seems to have now started to unwind. And so the market looked weak because it had no conviction in taking any kind of notice of anything. So when you look today and you see that we're closing above that high, well, that's all you need to see as far as I'm concerned to say, I don't have the trade I had before. This is inherently a different trade now. I'm certainly not bullish as we approach the highs here because I don't think anything has changed for the better relative to where we started the sell-off in mid-February, but we're basically back to that starting line. We've done a full round trip here on the S&P almost, and just the act of closing above this swing high is enough for me to take my little baby put verticals here and go home. So I've unwound that exposure. I've not flipped it over. It's not great that the dollar is down today because I flipped over that exposure on Friday from short to long. It hasn't crossed any Rubicons so far today. So we'll see if that one unclenches. But very interesting that the markets on this low volume day didn't seem to want to panic on the war, but do seem to want to rally on its apparent unwinding, which is a little bit incongruous, but I guess you can't keep I won't say a good market down, but you can't make an aloft market down.
It's a good market.
Who's more bearish? Who's more bearish, you or Tim Knight?
Well, that's a good question. I'm probably as bearish in my kind of disposition broadly, but I'm probably less bearish, certainly not bearish at all at this point in terms of my execution. In fact, since I've unwound these shorts, I'm actually net long equities at this point.
I mean, my next question was going to be, why does this bearish mostly reside in the western portion of the United States? Does it sit on a fault line or something? I mean, what is the deal?
What's up with you and Tim? We have ticks over here. They don't.
You might say this is the kind of contrarian thinking that eventually breeds a revolution, but eventually is the key word.
I don't know where to go with that. Volatility here is probably the most interesting aspect of all this. Back 2 weeks ago, the reference point was June 4th. You were looking at a VIX term structure where the front month, back month spread was roughly speaking 6 points or so. Last week on the 18th, when we were discussing this on air, it had shrunk to about 3 points, actually a little bit underneath that. Today, by the time we close out the session, you can see how normalcy is returning. Jamal, we're back to 5 and change. Is that all we really need to know here? VIX in contango, volumes low, technical drift high, summer here, end of quarter chase?
It's an interesting thing because like you said, we're in contango. I mean, just forget the numbers on the chart. Just look at the curve, right? We're in contango. And normally we'd be like, yeah, that's what I would expect when, we just had this huge day and we're basically near all-time highs and we're in contango. Where it gets interesting is the fact that you do have to pay attention to the numbers. And the fact remains is that this whole curve is upwards of 19 to 20, right? And that means something for those of us who trade. I mean, when you see VIX numbers in that range, it means things are a little bit elevated, but you can't ignore the fact that we're in contango. And really what it says to me is that the whole curve is a little bit higher because of the current, not even current, I shouldn't even say current. It's just the environment that we're in. The inputs to this environment say that things are going to move around a little bit more than what we've used to seeing over years in the past. That's what I read when I see this, when I see that we're having a VIX, at these levels, 17 and change. And again, it just came in a good bit today. But typically after a big 2-day rally like this and all risk is off, it would feel like VIX would probably be around 1549 as opposed to 1749. And I just think that it just means the whole volatility curve is a little bit more elevated because in the inputs to this curve environment say in 2 weeks, there could be some other risk situation that happens that we're not prepared for that pushes VIX back up to 1920. So I think we're just going to see a situation where we're moving more than 1+% on any given day in the stock market because that's what VIX is telling us.
We're at 17.49 here on the VIX. We're approaching the cycle lows that we've been at post-Liberation Day, if we want to consider that a separate cycle. Even in the VIX front month futures here, Jamal, you and I were talking about this on Futures Power Hour, so I suppose we can round this out and call it ultimately something that did come true. We have a VIX that's at 19.25 here, which is now the lowest close post-Liberation Day. Ilya, I know I have a feeling of what you're going to say, but then again, you're not executing on this idea. Are we complacent in the market right now?
I think there is definitely a sense of complacency here if you look at what was the not Iran news today. That, of course, was a testimony from Fed Chair Powell, who gave us a very familiar song and dance, came out and said, listen, we don't know. And we think that there's going to be a way that we're going to know when we know. But for now, the impacts of the tariffs are delayed. All major forecasters, including the Fed itself, are expecting significantly more inflation. From the tariffs. They think they can make it a one-off, but they don't know what it's going to look like. They're concerned that it might spill over into inflation expectations, so they're not in any kind of a hurry to cut until they actually see it happen. And it's a very familiar argument. Powell was saying, look, inflation is only a touch above 2% now. The unemployment rate is historically low at just a touch above 4%. Why would we want to front run this until we know what it is? We're just going to sit back and wait. We're in the middle of a 90-day pause on the full implementation of this thing. That means it's onboarding into the economy is going to be very extrapolated. So let's see. And the markets, they plainly do not agree. Because if you look at what Fed funds futures are telling you, The 2026 outlook for rates became more dovish after last week's Fed announcement, even though the Fed itself became less dovish. They dropped a rate cut from the outlook for next year. The market's added one. We're looking at break-even rates that are now falling again with oil receding after the Iran shock. They've been pinned to a low range since April, whereas stocks rebounded from the growth scare around the tariffs. Break-even rates never did. And so you're seeing the bond market telling the Fed, you're wrong. We're a lot more concerned with some kind of economic downturn than we are with any kind of an inflation shock. You should be cutting. And very clearly, the Fed is resisting. This is very much like last year. And last year, this produced a spook for stock markets, but more importantly, it juiced up bonds. It weighed on the dollar until we got into the Fed's actual cut when they went so big that it threw the markets in the opposite direction. But I think if the markets are screaming at you, we're concerned about growth, and the only economy growing in the global pie with any kind of consequence is the US, whereas Europe and China are stuck in the mud, you can't afford to lose that US growth lest you have a global recession, yet stocks are at within a hair, let's say, of the highs of the year. It smells like complacency to me.
It could be complacent, Jamal. Do you feel like it's complacent at these levels? Do you feel any different than you did earlier today?
No, not really. I do wonder, though. I mean, I agree with you. It is screaming that maybe we're like kind of possibly slowing growth. But like, do we need to cut? Do you feel like we need to cut? I mean, I know we're obviously you're looking at December, which is great when you're looking at the SR3 contract, and it's showing you 3.75. It's showing you the idea of two cuts. But do we need to cut? And if so, what is flashing that we need to cut? Obviously that's showing that we're possibly going to cut, but what is flashing that we need to cut? I'm actually like dead serious.
Falling inflation expectations. Because when inflation expectations fall, real interest rates surge. Interest rates are, and that's sort of the real cost of money in the economy. This has been the Fed's argument for rate cuts for going 2 years now, that essentially they've taken down inflation. That's pulled down inflation expectations. If rates, nominal rates, don't then come down, the nominal rates minus that now lower expected inflation gives you higher real cost of money, which crushes the economy. So the idea is you need to have a pacing down of nominal rates to match what inflation expectations have already done. And at baseline, you need to get to, in the best of all worlds, some kind of a foundation for a soft landing, and that's how you would do it, or the economy would hit a wall. Now, that doesn't mean that there's an economic downturn. That's sort of the Fed's rationale for we need to normalize rates from our fight with inflation. No economic downturn. This is just a maintenance thing that we have to do. And the markets have been okay with that, clearly. The larger issue is if they need to do something for growth. And again, these 5-year break-evens are suggesting that they do. But we'll see if and when, as it were.
That's the thing.
You know, you mentioned if the Fed should be cutting rates right now. It's an interesting question. There is a way to try to take a crack at this through an objective manner, mathematically. On the Atlanta Fed's website, they have the Taylor rule utility function, which is basically prescribing a Fed funds rate based on a few different inputs, GDP, inflation. And ultimately right now, when you talk about where that ends up, if we're thinking about a 2% target anchoring point, then the Fed funds rate probably could be higher. If we're looking at other models, maybe it could be a touch lower, but really on the low end, you're talking about 1 or 2 cuts if the current range is 4.25 to 4.5. So maybe 3 cuts on the high end, down to 3.5 to 3.75. but you're not exactly talking about Fed policy that's significantly out of whack. Like another cut or two by the end of the year, all things considered, policy would be in line with some of these neutral, objective mathematical equations to suggest where Fed policy should reside. If we didn't have the tariff overhang, though, as Powell said today, would we have cut rates by now? Probably. And I actually think that's the most important takeaway of what Powell said today was they see that the inflation, because of inventory cycles, will make its way through the economy in June, July, August, which it's June 24th, given the calendar we have in front of us. That realistically means that there's no Fed cut in July because they're waiting for that data, and then they can cut in September. So the Fed is a done deal for me in the short term. I actually think it's a really uninteresting conversation right now. I'm disinterested in talking about the Fed, despite being someone who cares so much about it, because Powell's telling us either stop the tariffs or we just got to wait and see.
Right.
And we could take issue with the data dependency versus the narrative that he's trying to construct, right? Waiting for a narrative to play out. It's not happening. Nothing's changing. So I think, Ilya, we talk, big picture, maintenance cuts, recession cuts, emergency cuts. We're not getting a maintenance cut anytime soon before September, by definition, for what Powell's told us. So the only paths forward in which we realize a potential rate cut would be emergency or recession conditions at the July meeting. And that's not a good outcome for stocks. So as a bull right now, I don't want cuts. I don't care about cuts. Not until July 31st from all, when our experts sit for those NASDAQ calls. The cuts can come afterwards. But really, realistically, like this is kind of where you want the Fed, sidelined in a corner. Trump's taking heat, giving them heat. I personally don't think that's a big deal, but it's low volume, low volatility, positive technical drift, summer months, and there's a lot of bricks in the wall of worry right now. Ilya, what was your big takeaway from Powell today? I know you just talked about him briefly, but is there anything, did you have that one clear idea like I did about don't worry about the Fed until September?
I mean, I think we've known not to worry about the Fed until September for a few days now. And we've been talking about how, just like last year, this is almost a full rerun. The Fed becomes a creature of the calendar, and then you know what's going to happen. So they're
going to cut Fed 50 in September again, aren't they?
Yeah, the Fed has September. Last year it was early November. This year it's late October and December. Right? If we know the Fed's not going in July, there is no meeting in August. There's Jackson Hole in August where they retune the lens and set the stage. So in September, they either cut or not, and then they have two more meetings, and they have 50 basis points on the calendar now. So if the next time they do anything of substance is September, then you only have but so much time to do those 50 basis points. You're updating the SEP in September. So you're in a situation here where the 50 basis points are not really an object of speculative interest. It's pretty much a done deal. There's not really time for much of anything else unless you scrap them suddenly. So
or you cut 50 in September and give 25 in December.
Or you do that. But if you update the SEP accordingly. But between now and September, there's all kinds of time where nothing substantive is going to happen. So this year, as far as sort of Fed opportunities to do things, unless they have an emergency meeting or something. So you have now very little room in that 2025 forecast. It's basically a done deal. But next year, it's a big, big difference. And so this is where I think speculative interest is. It's where it was all through the summer last year. It's what drove the moves last year. So I think when you look at what Powell said in particular about when the impact is expected to come, he said, we would expect to see meaningful tariff inflation effects in June, July, and August. Could he be any more transparent? In other words, by September, they'll make a call. But in the meantime, it's, do the markets believe what the Fed is selling? And the markets are saying they don't. That disparity is going to have to close. That's I think the most interesting thing here, that the Fed is basically saying we don't know, and the market's saying, but we do. And
the market's saying we do.
And we don't agree.
Okay, but I'm putting together the calendar here in my head right now, and maybe this would be an exercise. We need Mike's whiteboard, Jamal. Okay, so we have July 9th for the tariffs.
Yeah.
Okay, we have July 30th for the Fed. Are we all in agreement here that July 9th, if you let those tariffs lapse, then China has lower tariff rates than a lot of countries? That's not what the administration wants. So we'll assume July 9th gets kicked out. We have July 30th for the Fed. Fed's not going to cut. August 12th for Chinese tariffs. That one, I think, is the live issue we need to worry about over the summer. And that kind of comports with what happens during the summer. It feels like every year recently.
August.
Where something happens in August, right? In the second half of August, September's rocky, market bottom sometime in October. You rip November and December. Feels like clockwork. The main reason, in my opinion, and I'm not the only one with this opinion, and it's not a unique thought, but having read everyone's opinions on the issue, I've landed in this camp. Part of the reason why Trump pushed back the tariffs with China is because of the toy holiday season in the winter. Jamal, you and I spoke about this on Futures Power Hour, but inventory cycles for a lot of these goods are 6 months. And so if you put tariffs on in May, all of a sudden when parents are buying toys for their kids, you're not going to have 30 Barbies, you're going to have 2. It's not my line, that's the president's line, but that's because the inventories would be impacted in November. But if you put the tariffs back on and you ratchet back up the pressure in August, it's not going to disrupt peak consumption season here in the United States. And I think that's the window where all of a sudden you have Trump's tariffs going into play, a market that's getting ready and thinking about these potential rate cuts in September. And all of a sudden, okay, hold on, maybe we're not going to get those cuts because Trump is turning back on the tariff spigot. And that's going to give the Fed another excuse not to cut. And just that dynamic in the second half of August with a market that's seeing thin volumes and probably people mentally exhausted from what's been has this been a trying first half of the year? Apparently there's more gray in my beard. My daughter told me it looks like I'm dying. I think that maybe if we're going to be bullish here, we still have a window, Jamal. I think it's really difficult to get bared up, even if you have a complacency point of view. But all-time highs look like they're wanted. We squeeze, we get a blow-off top in over the next 4 to 6 weeks, and then we can play a little bit more bearish for August, September.
I mean, look, July 9th is really not that far away at this point, right? We're already at 624.
2 weeks.
So honestly, I feel like we wouldn't be doing what we did today if the market was really worried about the July 9th coming. And this is one of those things, right, when we talk about volatility and why volatility happens and ratchets up. It's the uncertainty of it all. And I would say now that even if we do, if that timeline lapses and there isn't another pushback and we hear it all over again, I don't think it's going to be that easy to telegraph and see we're going to be down to 4,800 again. I just don't think it happens that way. It's not to say we don't pull back in some form or fashion, but it's not going to happen in the same way that you thought it was. We've been trading too long to know that just doesn't occur that way. I wish it did, but it does not. But I would say, the market doesn't seem to be too worried about that. Your point about August is well taken. And again, it could be something we're not even aware of yet, right? That ends up creating that situation, whether it's August or September. I mean, last year we got both. But I say all this to say I'm starting to feel, after today, I'm not as worried about the prospect of July 9th, whether we actually get those tariffs in place or things change. Now, again, maybe in August, maybe it's the Chinese tariffs, maybe it's something different. But for now, look, markets made a clear signal over these last couple of days. And the charts showed it too. We were basically in sideways consolidation for a couple of weeks there, and then boom, we broke out higher. Could have easily broke out lower, but we broke out higher. And it feels like markets are going to start to drift a little bit higher until we do get the next thing, which could be July 9th. But I just don't think it's going to lead to the carnage that we saw earlier this year, which was wild, which created a nice double bottom, which was, I mean, dude, it's amazing how it ends up happening. Like a nice double bottom, nice little formulating handle at the end, and then boom, we break out higher. I mean, this is exactly what you want if you are looking at its chart technically to work. Whether you want it to happen or not, this is what you want to see. This is efficient markets.
It's certainly
efficient
very
markets.
clean technically. There's no question.
Ilya, you know, one idea, I kicked this out to Nick Batista earlier this morning over chat. If we look at previous episodes where the United States is engaged in limited military action, constitutionality aside, let's talk about, I mean, I know people think it's unconstitutional. I think it's constitutional. Article 2 defines the president's war powers pretty clearly. When we look at how the markets have responded to other episodes, it's usually stocks up, bonds down when the market perceives it to be a limited set of action. The threat has been lifted, so there's no reason to hold on to safe assets. Dollar's down a little bit today. Gold is off big. Stocks are up. That all kind of comports. But bonds are rallying.
Yeah.
That can't. Okay, so we've been pitched this story for a number of years. You've been a notable person who's kind of thumbed your nose at it, that the BRICS are coming to replace the US dollar, and that there's an alternative system out there that can rival the US-led Western financial system and ultimately US-led trade system. People think, why do we have so many ships at sea? We're just projecting our empire. It's really to protect commerce. It's really to make sure the shipping lanes are secured. Okay, so Iran is part of that axis, that nexus of countries that are part of the BRICS network. China and Russia, obviously the military might, China being the economic might, India perhaps rising as an Indian military might, but Iran is supposed to be part of the military wing. They have Iranian, or they have Russian technology, weapons platforms. They do have some American stuff, the F-14 Tomcat, which is really interesting if you read the history about why they have that plane in particular. Nevertheless, the point is that Iran, which is supposed to be like the barking dog that does Russia's bidding effectively through the Middle East, was just defanged very quickly. Russia can't push Ukraine out of its own backyard. And so all of a sudden, a Western-led system, what alternative is really coming up? What might does it have?
Alternative.
Well, we know that.
Alternative.
But can we contextualize that in, say, the tariff negotiations? Because it feels like some of the signaling from the rest of the world throughout all this has been, well, you know, we'll just all work together and we'll go to China and we'll work with the, you know, the independent countries and the BRICS and we'll hammer out deals. And Europe is turning to China, right? Are they going to let BYD into their markets?
Mm-hmm. Come out to
doesn't
the
this kind of
get together? We're having a few laughs.
But doesn't this reframe these negotiations with the U.S.? The U.S. still has the ability to project strength, and the alternatives out there, they're kind of flimsy paper tigers at best.
So these are not the same idea necessarily. So there's two separate things here. Number one, this off-ramp with China that we just had after we went to basically an embargo was pushed from the U.S. side because U.S. auto manufacturers really, really, really needed the smelting and processing of rare earths into all of the various things that automakers need.
We need the magnets.
And we did not have a backup. So, and China was basically digging in. Now, is there a legitimate alternative to the US dollar as the global currency of commerce? Not even close. Is there a legitimate alternative to the US Treasury bond as the benchmark risk-free asset for global commerce? Not even close. Is the US at risk of default? Not even close. Not even remotely. Not even kind of. Does that mean we're still on a unsustainable fiscal trajectory? Sure, yes. Have been for a while. It's gotten worse. It'll probably get worse before it gets better if this big, beautiful bill thing passes. It's very deficit expanding. But those things and the tariff negotiations are not quite the same thing. I think what we just saw with China is they were willing to wait us out despite the fact that we're the world's largest consumer market and by far their biggest customer. They can't replace us or anything like it. Also, they were getting ready to dump all kinds of excess capacity on global markets, which nobody wanted. That was a very significant disinflationary or even deflationary risk. Europe was worried about it. Australia was worried about it. Japan and Korea were worried about it, on and on and on and on. But we've managed to walk it back, and it's at our insistence, not China's, because we basically had to yell uncle, having overshot on exactly what kind of a tariff regime we actually want. The European Union came out just today and said, if you think we're the UK on this baseline 10% tariff, let us disabuse you of that notion right now. That's not what we're doing. So it's one thing to say that the dollar isn't getting replaced, the U.S. Treasury isn't getting replaced, the U.S.-based economic order isn't getting replaced. That's just the idea that there is a viable alternative is just nonsense. But at the same time, our trading partners do have leverage. And that does not make for smooth negotiations going forward.
Looking at this rally here, guys, looking at the top performers as we make our way, well, we're a little bit more past the halfway mark here of overtime. Semiconductors, Jamal, just like on Futures Power Hour, they ultimately do finish the day higher. This is the highest close that we've seen going back to last July, for what it's worth, in this market. Pretty impressive, breaking the downtrend from the July and those February swing highs here. It's a consolidation that lasted a week and a half, but it's now a fresh 2025 print to the upside. Telecom likewise is performing well. I was scrolling through a few of those names here. This is a fresh closing high for the year. A name like Cisco pops up on my radar today, which is closing up at a fresh all-time high. The tech names overall were very, very strong. Technology now at a closing high for the year, breaching everything that we saw pre-Liberation Day and then some. And Ilya, we're breaking the highs that we had prior to that growth scare kicking in February, for what it's worth. I only know that because that was this candle, and Mom's birthday top ticked the market for the year, so can't forget that. Okay, I remember having dinner with her. She's like, "Oh, stocks are doing pretty well this year, Mom." I'm like, "Yeah, they're going to keep going up." they have kept going
dinner
up.
with your mom anytime soon, or?
No, they're going to California this weekend, so. No, not anytime soon. But you have the growthy stuff on top, right? You're looking at the
that's the indicator.
Banks.
That's
banks
the indicator
here.
Right there.
Yeah, well, I was told last week that when Tom goes on vacation, something bad happens to the market. And consider my surprise when I saw the headlines that the U.S. bombed Iran.
Yeah, we can debunk that theory now. It's over. It's
So, but like everything growthy is kind of working here, and all the stuff on the downside is commodities related. It's energy, it's gold miners, it's materials, it's consumer staples, it's defensive names right now. Mm-hmm. Even on the broader basis, QQEW is up 1.71% today compared to the broader NASDAQ. We go to the triple Qs up 1.53%. RSP 0.97% higher. So not quite, we look at SPY, this is up 1.1%, but tech distribution is going on. Small caps are up 1.21%, a little bit better than their S&P 500 counterpart. Mm-hmm. Jamal, I feel like I'm not speaking to the fact that I think the economy is in great shape or that we're going to be getting a lot of monetary support. Money is being spent. The federal government's going to be spending a buttload of money. That's a macro term. And it's going to continue for the foreseeable future. So public sector surpluses, or deficits, or private sector surpluses, that tends to be inflationary. People are offside still. Why wouldn't this market just squeeze now for the next 7 days into the end of the quarter?
I don't see why I wouldn't. Honestly, I mean, people are out of dollars and they seem to be into the stock market right now. The one thing I will say, I do look at the S&P 500 names above the 50-day moving average, like we have on the platform, that $SPXA50R. And right about now, it's 76%. Usually when we get around 70+%, 80%, we see a little bit of a pullback. Does that little bit of a pullback happen in the coming days, and then we'd get the end of the month rally, and then that heads into the beginning of July? Or do we rally into the end of the week, and then or even the end of the month, and then beginning of July get a little rollover. Because I think we had that last year, if I'm not correct. I remember because I was pissed off and I traded it wrong. So, but I mean, it's one of the two, and I think maybe there could be again, I'm saying pullbacks, not sell off. I think the idea of a sell off is only really happening on some really bad news. Really something bad with regard to tariffs or something else we're just not aware of yet, which could easily be manufactured in the stock market we're in. Again, that's why we're back to VIX. We have VIX of 17 and change and VIX futures over 19.20 because that's how it has happened this year. And I think that's how the market is still interpreting the potential chance for any random thing that we hadn't even thought of yet that could derail the rally. But, without at the risk of talking my book, yeah, I mean, I from what I'm seeing right now, there's still an area where, again, we're in contango. Even though it's a higher contango, it's still contango. And markets are just a stone's throw away from all-time highs. So it's something you alluded to earlier on Futures Power Hour, Chris. Please don't poke the bear and talk about taco trades, et cetera, because it could unravel all of everything at some point or another. But I don't see anything in the way right now of reaching all-time highs. I mean, again, I just think. Sure, volume might end up drying up a little bit here as we head into the holiday, end of the quarter / holiday. But I don't think that's necessarily a bad thing for all-time highs. I think that ends up being good somehow.
Guys, we haven't touched on oil yet. I suppose that's the elephant in the room here. It's down another 5% today, driving much of this. I couldn't help but notice a very eye-raising headline today on MarketWatch. This just came across a few minutes ago. Why falling oil prices could actually drag down the stock market.
What?
Oh boy.
Mark Colbert, you need to.
Why can't we just have nice things? If oil's up, it's inflationary. If oil's down, it's recessionary. If interest rates up, it's wars are getting crowded out. If interest rates are down, savers are getting screwed. No one can be happy.
Look, if you break the bottom range on oil, it won't be the break of the bottom range on oil that's causing the recession fears. It'll be the recession fears that are causing the bottom break on the range in oil. So let's not get ahead of our skis here. What we've done is we had a geopolitical scare. We've round-tripped the whole thing, and we're back to where we started. If you put a horizontal line right where those April-May highs are, where are we? Back to the starting line. There's no growth scare here. We're in the middle of the range. Now we see. Show me a break back through that sort of axis level. And okay, let's talk about why. Let's see what is happening in context. Do you have a push higher in the bonds in context? Is there any kind of a shuffling in Fed funds futures forward in on the curve for when the cuts are coming? Is gold rallying? Okay, now we can start to piece together a cross-market narrative saying the market's getting concerned about growth. Like in a more present tense kind of way. Now you look at the bond market, as we were saying before, and they're concerned about growth in a 5-year break-even rate kind of way. That's not this year. The Citigroup Economic Surprise Index is fading. The Atlanta Fed GDP now model is showing the most recent data is negative. You're seeing it, but it's not now. It's not, oh my God, concerns today. To say that the drop in oil, returning it back to where it started before the sort of geopolitics took it over, is some kind of a growth indicator is, to me, kind of odd.
Oil's the interesting play now because you said we've round tripped. We're back to this kind of dividing line in the sand right near 64 or 65, depending upon what contract you're looking at. Jamal, you and I were looking at some adjustments today on futures power hour. I got out of my short deltas in crude. I also neutralized the original short iron condor position that was put on back towards the end of May, which by some miracle was able to get out with a profit. But thinking about the volatility in this market here, it's continuing to come off. It's still fairly rich. It's a 48.4 IVR. That's not nothing. I switched my particular stance today into the CLU5 contract, and now in both the short put spread and the short call spread and a short iron condor, effectively wrapped around the highs that we've seen recently. I'm not of the mindset that we're going to go back above them anytime soon. I also don't think we're clearing out the recent lows anytime soon, at least in the next 45 and 21 day out window type of situation. It's not, again, oil is not something that is super sexy to trade when it's not going through the throes of geopolitics or like COVID, right? How many times over the past few years, Jamal, on Futures Power Hour, have we said something like, what's the price of oil today? Let's bet on it being that tomorrow. And it works out for weeks and months and stretches of periods of time. If this is off the front burner, what did oil do after Liberation Day? Check down into a new range. What happened when we see the tariffs are getting lifted and we talk with China? We start moving up into a different part of the range. But oil fundamentally between like $64 and $75 a barrel, that is not problematic for the U.S. economy. It's only when you go above like $85 a barrel do both bonds and stocks start to get a little testy. And then once you're above 100, everyone's pissed off. But 65, 70, 75, as long as we don't get there too fast, the economy can handle this. And if anything, oil is correlated to demand for global goods. It has such a strong correlation with global GDP. So we don't want to see oil tank. The best case scenario from here on out is that oil stabilizes and slowly grinds higher, which we've just had an experience of a drop of more than 10% over the past 2 days. My search here tells me that oil on average produces a one-day bounce of 2.1%, produces a 1 week return of 4.8%, historically speaking. So a stabilization around these levels, like we flush this from the system. We should take advantage of the vol while we have it, but fading oil because of the geopolitical risk, that trade is dead. Put it in the pocket, it's over.
I'd have to look, man, but I don't know the last time we ever saw oil make two separate 10+% moves within a 2-month period for completely different reasons, and you get completely different reactions in the stock market. I don't know if that's really happened that I can think of off the top of my head. It's pretty crazy. And so it's clear, a person who wrote the article obviously is hunting for clicks. I'm not sure of the substance of the article, but as long as they detail the fact of what I just said, that's the most important part. Obviously, earlier in the year, we were like, oh my God, global demand is going down and, we're in a recessionary situation. And here it was more of the typical what we usually see oil move on, right? The geopolitical stuff type situation that we got the big moves recently, and obviously a different reaction from the stock market. So I know if you've caught them, they've been interesting trades, right? Like with oil and these moves, if you're one who likes to trade it for moves, if you just waited instead for the vol, I mean, that has totally worked out too. Like I said, I completely kind of butchered an oil futures trade, mostly because I was just worried about my upside and a condor that I had, a different condor than the one we initially had on, and that didn't quite work out. So I had to deal with the brunt of that yesterday. But fortunately, though, right? Like it ended up working out for me. Why? Because again, I'm long in NASDAQ call spreads. And so I was able to benefit, or at least from the market going up. So I am not interested in doing anything price-wise here as far as like picking direction in oil. I think, to Ilya's point, it's right back at sort of an average level now, I should say. It's probably starting a new average level, and I guess we'll have to wait and see. But it seems like it's going to start a new average level of around 64, 65. That's in the absence of all this discussion, if there's any, warmongering, et cetera. So that's kind of what oil is, but it does give you that opportunity to trade the vol. I mean, dude, the spike in vol recently was one of the biggest spikes we've seen in a while, and that's been the best thing to take advantage of. So, but again, it has been nice to at least kind of pay attention to oil for these different reasons, whether it was earlier for a recession and it was flashing recession signals, or now it's saying it's de-escalation in any tensions in the Middle East.
After that initial oil vol spike in 22, when we saw Russia invade Ukraine, it did subside a few weeks later, but oil vol, when we're looking at, you can do this on the platform. If you go to OVX:CGI, you can pull up the oil volatility from the COV crude oil ETF, USO. It hung in this 50 area for a little while, for several months. So you were playing basically chop in the market, but vol never really came out. I wonder, given today's action, not that we do technical analysis on volatility, but
we do not.
We did gap open lower in oil vol. We traded lower over the course of the session. Technically speaking, oil did close higher here today than where it opened at in the US hours. And it's coming against a pivot point in May. I got no technical analysis on volatility metrics, but maybe just playing for it to get pinned here. Vol has come off a great deal already. It could continue to subside like it did after Liberation Day, but Liberation Day lows are what, 33 or so? And it took several weeks to get down there. This could be a slow burn, is my point. A ceasefire could be broken at any time. Last night, it looked like the ceasefire was not going to work because it was starting at 12 Eastern, 12 a.m. Eastern time, as President Trump was up tweeting, not just about the ceasefire, also about monetary policy, as one is wont to do at 1:15 in the morning. You see here that ultimately
makes perfect sense to me.
I mean, is he doing that or is somebody else doing it? Somebody else is doing that, right?
It's definitely him. It's absolutely him. I have a friend who in Trump's first term worked in the White House communications office, and she said that Trump tweets or dictates all of his tweets.
Nice.
To someone sitting next to him. So it's authentic.
Does he dictate the punctuation too, where the random things are capitalized and some things are in all caps?
Yes.
Amazing.
Yes, verbally, yeah. Anyway, OBX. So volatility's come off. It bounced. I would think that if we're going to be playing oil here, we have to just be cognizant of the fact that there's some, will the ceasefire hold? It's a good question.
I'll tell you
Is
what.
there anything that anyone we could ask about this?
Ooh.
Maybe you should tweet the Ayatollah again.
One thing that's really interesting to me when you look at, again, and this is, of course, this is just a natural thing that happens with the exchanges, right? But when you look at what it costs to trade an MCL contract right now, that lets you know how high vol kind of is. It's like $1,600. This thing was like, you could get these for like $900 a couple months ago. So that part has really changed. It lets you know there's a lot of vol in there.
Jamal, we're going to find out some information here. We just tweeted at direct message the Ayatollah. Will the ceasefire with Israel hold? Please respond. Oh, no. I will let everyone know if that. He hasn't responded to a single thing. I know he's been busy, but you got to. My wife always says you got to water your gardens with your friends, right? If you don't talk to your people, then your friendships wilt.
What kind of heartless person doesn't answer to the John Cusack say anything gif? I don't understand.
In fairness, the Ayatollah has been hidden in a bunker for a few days here, which is actually an interesting kind of overlay on all of this, because it seems like the IRGC, the military part of the establishment, has very quickly reasserted itself with new, young leadership and seems to have edged out the clerics here for who currently runs Iran. And The Economist had a really nice article about this earlier today, talking about what has this strike actually done, and did we sort of remove the capacity for infighting with the old guard and the new that was actually keeping Iran more paralyzed, and have we now filled them with a terrible resolve? And there's certainly some evidence to that extent. So this is going to be interesting, but it's not going to be near term. It'll be quite a while before Iran can reconstitute, I would think, any kind of conventional capacity, even though reports now, as we're talking here, coming across from ones I'm seeing are from CNN, suggesting that in fact, the nuclear program was not utterly destroyed, as the president suggested yesterday. That initial intelligence report suggests that actually no. But in any case, the concern here isn't right now. The concern here is what happens when a reconstituted Iran let's say, decides to use some of its extensive global network of non-standard actors to strike some sort of soft target. And how does that work going forward? So, of course, hopefully nothing like that happens, and we'll see. But in the near term, this doesn't seem like it's anything that the markets are going to care about right now. We're back to the deciding line for, do we have a growth scare or don't we, as far as the price action on crude. This is where we were stuck last time with that conversation.
I mean, this chapter is, if you're reading the intelligence that was leaked to the New York Times and CNN, according to the reporting here, which the White House has vehemently dismissed already, but entrances to the nuclear facilities were destroyed, but the buildings within the mountains underground were not. And so this may set back the Iranian nuclear problem or program for a few months right now. So perhaps we see this pop up again in the future, because they still have 400 kilograms of enriched uranium, which at 60%, you can't use it for civilian purposes like a nuclear reactor. You can use it for research, for isotopes, for X-rays, almost, a little bit more enrichment thereafter. But it's not a linear scale of enrichment. It actually takes a lot more to enrich it to 5%. Like once you get to the first 5%, you've done a lot of the work. Once you get to 20, you've done most of the work. The jump between 60% and 90% enrichment, from what I've read, is a lot less difficult than the first 5% of enrichment. Okay, but we said here on Overtime, Ilya, back with Dylan, back in February, because sometimes I tweet these things out just for the sake of there being a timestamp. Okay, one of the risks of the Ukraine war was that there'd be nuclear proliferation. And we've seen several examples of France and Germany and Poland all jumping into the fray. Iran is very much part of that. And if you're Iran right now and you're looking around the room and you go, what happened to Gaddafi? Oh, yeah, he didn't have nuclear weapons. What happened to Kim Jong-un? Oh, he does have nukes. Okay, how about Saddam?
I was told the Libyans had the enriched uranium in Back to the Future, so.
They had an enriched uranium truck in Command and Conquer. That was like their special weapon. That's what I remember about Libya. I was always so confused as a child, like, why is Libya one of the bad countries?
I know, right? Okay, sorry. I don't want to make this go off the rails at the end. I was too.
Yeah. Okay. So it wasn't just me. I understood the U.S. and Korea and like Germany on one side, but like Libya, what did they do? Now we know. So there's an incentive structure right now in the world. Russia hasn't been rolled over because of its nukes. If Russia had attacked Ukraine without nuclear weapons, I think the U.S. would probably be a little bit more involved. And I don't think a lot of people would disagree with that assessment.
Clearly.
Right. I have seen a question pop up in the chat. How come we didn't do this with North Korea? And this wasn't today. This was yesterday. So one of my good friends growing up, until he was laid off recently from the Trump administration cuts, worked for one of the government's initiatives abroad in Africa, did a lot of foreign policy work in Kenya, various countries over the years. And he's become somewhat of a foreign policy expert. And so I like to sit down with him. We have these dinners with our wives now, and I ask him very extreme questions about foreign policy that he talks me off the cliff about. And so I remember talking with him and recently rehashed this conversation. What would happen if North Korea, we try to do this to North Korea? Seoul, South Korea, is within North Korea's artillery range, right? So if we try to dismantle North Korea's nuclear program at any point in time, it would incur massive civilian casualties. Whereas if you think about Iraq and Iran, the flight distance of missiles and bombs to, say, Israel, our closest ally in the region, is several minutes, and there's an opportunity to shoot down and deter those missiles to get people to shelter in place. So it's not one for one, but this story is not over. It's over for now. This chapter's closed, but the book is still being written. We'll learn more tomorrow, though, because Overtime is out of time. We'll see everyone on Wednesday, of course. Ilya's up next here with Macro Money. Tasty Live continues. So for Ilya Spivak and Jamal Chandler, thanks for tuning in. I've been Chris Vecchio. See you on the other side of a commercial break.
See you there, everybody.
In the
the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
If you missed the live show, here's our cherry on top weekly recap.
Hola!
Look at you guys looking like spy versus spy.
I'm in the UK. Vanetta, I got in. They let me in.
So how's the vibe
Anyway.
in London? How's the weather? What's the tea?
So Britt and I are getting off the plane. We're like, should we wait for Batista's? And I'm like, she's like, should we wait for the Batistas? It's the right thing to do. And I'm like, all right, yeah. And it's like European vacation. You know, we are traveling with that, with that crew. So I have a little suitcase and a backpack. Britt has a little suitcase and a backpack. The Batistas, 75 bags. It's like coming to America.
Tom, we have a rule in the Batista house. The wife has to pay for the vacation when we're on vacation. So she has one suitcase full of shoes. So we need to just
She's paying it forward.
She's paying it forward.
Then why does your son need a suitcase that's bigger than me? So anyway,
Vinny's frosted tips aren't gonna frost themselves. He needs hair products.
against everybody else, because I didn't want to embarrass him in front of his wife. Everybody else knows the rule. If you check bags, we're leaving you.
That's right.
You get left behind.
You get left behind.
You get left behind. You get left behind. That's the rule. An hour later, we're sitting there like, oh my God, they're coming off one bag at a time.
It was about 45 minutes. I will give you that. It really was. And I was embarrassed. My wife is in this train with all these people and everything, like Tom. We're traveling with Tom. We didn't get into the concierge level. We sat in coach. We're sitting on a train.
So anyway, we made it. We took the train. Then I had to walk. Britt made me walk like a mile.
Then it should be nothing. A big, strong man like
You should
you.
have carried it. I've never seen it before on a train. There were women getting up for him and saying, will you please sit? Would you like my seat?
I mean,
seriously.
To be fair, when he starts lurching, it's jarring if you're not used to it.
Good morning, you knuckleheads, and welcome back to the show, Tasty Live.
That was kind of low energy.
Good morning, knuckleheads.
It sounded like he was going into like a dramatic monologue.
Right?
Yeah, Beth, was that okay?
No.
Oh my God.
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course.
Ready to learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Well, we've heard from Fed Chair Powell and we've heard from President Trump. Apparently, the U.S.-Israel-Iran war has been paused, and there is a ceasefire that everybody is begrudgingly going to accept for now. And apparently, we are in no hurry to cut interest rates in any way, shape, or form, at least until we get to September. So where are we going now? That's what we're going to tackle here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. We're going to unpack here a little bit, first of all, what the markets did, and then what the actual substance of these comments from the Fed chair looked like, because, of course, the geopolitical narrative is pretty much self-explanatory here when we look at today's cross-asset performance. Stocks put in a cheery day. S&P up 1.1%. NASDAQ even stronger, clearly 3.1% there. Bonds edge up a little bit, which is an interesting sort of a reflection of what is going on here, and perhaps a slightly incongruous one if geopolitics were the only thing at play. But of course, they weren't, and so we'll get to that in a moment. But otherwise, a fairly risk-on day. Euro up against the dollar. Yen a little bit higher, perhaps echoing what's going on in the bond market with those yields coming off. Crude oil, of course, the standout, down another 5.08%, having fallen over 8% yesterday. Gold in by almost 2%. Bitcoin showing signs of robust risk appetite, rising almost 2.6%. So a cheery mood generally in markets, and bonds and the yen kind of the standouts that seem to hearken a little bit to what's going on with monetary policy and these Fed comments. So what we had today was the first day of testimony, semi-annual testimony from Fed Chair Powell in the U.S. Congress. We had the House of Representatives here first. Senate is coming up tomorrow. The prepared remarks should be give or take the same. The Q&A portion obviously is going to be different, and we'll see if anything emerges there in that Q&A portion tomorrow that clashes in any way with what we saw today. But at this point, it seems like we're in for a familiar story. So once again, from the prepared remarks here first, Chair Powell saying once again that the Fed is very much in a wait and see sort of mode, because they expect that tariffs are going to push up inflation and weigh on economic activity, but they don't know exactly to what extent and how all of this will look. And so they're waiting to make a decision. And in the meantime, with an unemployment rate at 4.2%, which is very low by historical norms, and an inflation rate that's almost to target, and certainly much closer to target than not, at 2.4% on headline CPI most recently. The Fed really doesn't have an impetus to go quickly this way or that. It can afford to wait to see the impact from the tariffs materialize whichever way it's going to. And we see here that the expectation is that's likely to appear in June, July, and August. We, of course, haven't seen that inflation data yet. We'll have to wait and see. But clearly, the Fed themselves are in watch and wait mode, as Powell said here. And the concern, of course, is that if the Fed is right and the tariffs are inflationary, they want to keep them to a one-off increase and not something that drives up inflation expectations. Now, in the Q&A that followed, we see reiteration that the Fed does want to cut rates, and a majority of policymakers think that's what's going to happen. But they can't be cutting, and the reason that they're not cutting is forecasting, both at the Fed and more generally, is pointing to a significant increase in inflation this year, and that's, of course, that tariff impact. Now, Powell goes on to say that if not for that inflation forecast, they would have been cutting already. But as long as the economy is strong, they can pause here for a bit. And that, of course, then gives us what our reaction function looks like. For the Fed to start to move on rates, they want, or they'll need to see the economy weaken. And that, of course, means that from the market's perspective, the Fed is going to be later than usual to the rate cut party. That the Fed is going to either wait for the tariff impact to appear, then dissipate, and hopefully with no economic consequences as far as a lasting hit to growth, or that lasting hit to growth appears, the Fed can reason that the demand destruction there will countervail whatever one-off price increase from the tariffs, and they can focus wholeheartedly on that part of it and cut. But short of evidence this way or that, they're stuck. This, of course, comports with the FOMC forecasting update, the summary of economic projections that we got last week. We can see here downgrades to expectations for growth, a parallel upgrade to expectations for the unemployment rate. So again, a weaker economy and higher inflation, much across the board over the 3 years of the forecast. And what the Fed seems to be saying on the rates front is that because the impact of the tariffs they now expect to see in June, July, and August, and it's somewhat delayed, not surprising, of course, with the 90-day pauses that President Trump announced to the sort of full breadth of the tariff regime in April, where the tariffs, the reciprocal rates, so-called, on most trading partners go up in early July and on China in mid-August, unless, of course, these pauses are extended. We have this kind of delayed reaction, and in any case, the rise in tariffs takes time to work its way through the economy, much like rate cuts do, or rate hikes for that matter. It takes a while for the economy to absorb a level change in prices for goods, for services, and for credit. So what we have is the Fed then saying, before we thought we'd go 50 basis points in cuts this year and again in 2026. That's what you see right here in the March set of numbers, and that mirrors what they said in December. Now we see we're going to take a year longer to get to that second 50 basis points. Now we don't get to 3.4 until 2027. And so the full scope for rate cuts over the 3-year period here, we can see from 3.1 to 3.4 has been cut by one increment, by one sort of standard size 25 basis point step. And that elongating of the timeline here seems to occur starting from next year. Now, what's interesting is, on some level, the Fed has a point. The most recent PMI data does, in fact, suggest that the economy flirted with standstill earlier in the year, but has now kind of stabilized, it would seem, clearly at a lower level than last year, but not dissimilar from where things idled in 2023. So, on some level, the economy is not screaming for immediate firefighting. This is, of course, the latest update to the S&P Global PMI data, the June update. And as ever, PMI data is expressed centered around the 50 line, where that's neither growth nor contraction. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So you see here, right at the beginning of the year, with the onset of these tariffs and that growth scare that we saw from mid-February right until that crescendo in early April, there was a slowing down in U.S. growth to basically the 50 level across both services and manufacturing. And that, of course, took the overall economy the same direction. Now, obviously, there's been a slowdown versus the levels of growth that were on display in the second half of last year, but we're certainly off standstill now and back to basically where growth has averaged. It's been a slowdown, but not a catastrophic one, or not certainly anything that raises any eyebrows at face value. Moreover, just last week, we saw that U.S. consumer confidence has meaningfully improved. The survey from the University of Michigan here showing that as inflation expectations linked to worries about the tariffs have eased, in June they've come down from 6.6 to 5.1%, so too consumer confidence has come off its critical lows going back 3 years to essentially the COVID bottoms, and has started a meaningful recovery. So indeed, it does look like uncertainty is waning, the economy is holding up, and the Fed is not really getting yelled at by the economy, or so it seems. But the markets, interestingly, are of another view. And this is where there is a clear wrinkle in the narrative. At the beginning of the year, as we just saw that there was a growth scare, and we had the bond market's inflation expectations head lower around the idea that what this growth scare would mean is a downturn in the economy and demand destruction, and this would mean that there is a pull down on prices as supply starts to overshoot waning demand. There's discounting, and invariably, as there is in an economic downturn, prices start to retrench, as it were. And what you have here then is a parallel decline in the S&P 500 here in the yellow, as well as break evens for the 5 and 10 year maturities, sort of the liquid ones that you can look at as indicators. And obviously, since early April, stocks have almost fully recovered these losses as sentiment has improved, but these inflation expectations are still pinned. And after this little scare here around the spike in oil prices linked to U.S., Iran, Israel conflagration, now that that oil price spike has basically fully unwound, we're again pinned inside this range established all the way back now almost 3 months ago. And so the bond market seems to be saying the Fed's confused, but the markets know which way it's time to jump. They're not concerned about sticky inflation from the tariffs. They're concerned about an economic growth downturn that keeps inflation low. And in fact, you can see that disparity in full relief, as it were, in what Fed funds futures are telling us about where the markets think the Fed is going next year. The 50 basis points they anticipated for this year, the markets have matched, and that largely seems intuitive because, of course, the calendar is limited. The markets don't expect any rate moves in July. We can see that here. We're sitting at the median rate here for this month and next. We start to tilt a little bit lower come September, and by October and December, we have our 2 cuts. Now, what's interesting is that since the Fed meeting last week, this curve has actually become more dovish, despite all of the counter narrative from the Fed, including Powell's comments just today. And we can see here that for 2026, the wedge has increasingly widened, and now the markets actually see 61 basis points in rate cuts there. That's at least 2 and about a 50-50 shot at a third. Whereas we just saw from the Fed's reckoning, they only see 1. And so we now have a significant disparity between what the market says the Fed needs to be prioritizing and where the economy is going, and what the Fed anticipates. And what makes this ever sharper of a contrast is that the markets do seem to have at least the momentum behind economic data on their side. This is the Economic Surprise Index from Citigroup, and what it measures is how economic data is performing relative to forecasts. That is, whether economic numbers are beating or undershooting forecasts, and it's scaled by the volatility of the currency market's response to the data. So when data is more impactful, it impacts the index more. It's also skewed toward recency. And so recent misses impact the data more as well. So what we have here is a fairly clear story going back to the middle of May, where U.S. economic data is increasingly underperforming relative to baseline forecasts. In other words, the economy is turning out results that are worse than what economists' models say they should be. Now, we can clearly see that this is the main sort of drag on averages for the G10, as well as for the global index right here, because if we see what's going on with emerging markets, they're holding up fairly well. Here's that zero line dividing what's going on with surprises upside versus downside. Above zero is surprising upside. Below zero is surprising downside. Obviously, it's immediately jumping out here that the U.S. is the only line on this chart that's under zero. But also, we can clearly see that emerging markets are actually showing relatively upbeat economic data relative to forecasts after an improvement from late April onward. Similar story for the Eurozone. There we've seen improvements since about late April, early May onward, and the slope is higher. And so this weakness in the G10 index, clearly not Europe. This weakness in the global index, clearly not emerging markets. And so the U.S. is the weak link here, seemingly. That, of course, is a troubling sort of setup when we consider, as we often do, that global growth is primarily powered by 3 big economies: the Eurozone, China, and the U.S. And if we take a look at the current setup for how those economies are doing, we are in a story very similar to where we were last year. Notice that these are composite PMI indexes again. And these are for these three key economies. Here's the one for the US. We can clearly see the pace of growth here is nice and strong in the second half of last year. In fact, the strongest we'd seen it since early 2022. Meanwhile, through the second half of last year, growth rates in China come down and slow to standstill. The Eurozone attempts a shallow rebound after recessionary conditions in the latter half of 2023. That fails, and we end up at standstill once again. Now, we don't have June PMI numbers for China yet, so these are the latest numbers from May, extrapolated here in the orange to make them stand out as forecasts. The latest numbers from the US and the Eurozone came out just this Monday, and we see the very same story here. China and Europe are idling. The US is now a lower growth single point of failure. And if this gives way, as the dynamics here seem to suggest, well, then the global economy doesn't have much of a leg to stand on. Because if these two pieces are offline, and this one slows to a crawl, whereas the rest of the 42% are largely vendors depending on these three to feed them demand via buying their exports, once again, a global recession starts to get inescapable. Now, to the Fed's point, we're not there yet. And clearly, the U.S. economy is again holding up the entire pie. But if this continues to happen, that's going to become a very serious question. And as we look at this performance today, we sort of beckon to ask, at what point do markets bake in the sort of cheerful reaction to geopolitical de-escalation and get back to looking at the growth story? And of course, the Fed's own reckoning here that what they need to see to jump this way or that is some kind of clear give in the economy. Of course, raises the question, who ultimately is right? Is it the Fed in only forecasting 3 cuts between now and the end of next year? Or is it the markets who are leaning toward 5? And that is Macro Money for today. As ever, we are here every Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm going to be back here in just 30 minutes' time, as I am every Tuesday, with Victor Jones for the Price of Truth. Back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Your crypto needs a wallet, And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Oh yeah. Tasty Nation, good morning.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back? But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
What is going on, everybody, and welcome back to Risk and Reward. Another volatile week. Got a lot of news over the weekend. We got a lot of geopolitical stuff going on, but we're still here. Gus, what's going on, brother? How we doing?
Oh man, doing good, hanging in. We missed Thursday with the market being closed. It feels like it's been too long since I was in this studio. I've joined the stream here to some threats happening in the chat. Theta Trader, I'm reporting you to HR, my man. He said I'm going to drive down to Chicago and offer fisticuffs to Gus. Not that it's in any way his fault, but he's the new guy. I'm catching strays right before I come on air here.
Yeah, it happens to the best of us,
he
catching
says
strays. Yeah, hey, catching strays happens to the best of us. It's only right. But no, it does feel like we haven't chopped it up in a little while. I feel like we got a lot to catch up on. It feels like we speak every Tuesday, Thursday. Now it's been an entire week. It's been even longer. And I mean, we got wars going on. Look what happens. We miss one day, and we got wars going on.
We miss one day, and foreign nations start bombing each other. It was actually our fault, guys. This is now the dots are connecting. The volatility only comes when we're not here. That's the rules.
Yeah. We actually said it was coming. No, but.
We did actually. No, actually, I remember when it all started popping off. I was like, man, we called this. We were so on this.
Yeah, we might have. So yeah, make sure you guys tune in every Tuesday, Thursday, 4:30 Central. Miss the next call outs. But other than that, though,
yeah. What's our bold prediction for this week, guys? The moon's gonna crash into Earth on July 3rd. You heard it here first.
Within this time window, we're on record right now. No, before we get into all of that though, I kind of wanted to touch on it. We got a new championship. Shai, MVP of the year, ended up becoming a new championship over the last, what was it, last night or the last couple of days? I'm losing time here. 2 nights ago. What are your thoughts on that? We got a new championship in the house.
Yeah, bittersweet to see Hallie go down like that in Game 7. Would have
that's tough.
You know,
that's tough.
It kind of dulls the otherwise electric, iconic series that was forming itself here. But the Thunder were the best team all year, and I think they deserve it. People will say what they want to about the refs and how many free throws Shai Gilgeous-Alexander shoots, but those are the rules.
A championship's a championship.
Yeah, championship's a chip, and he's playing within the rules. You can say it's not basketball, but they should rewrite the rules if they want to keep this out the way they had to do for Harden. So yeah, congratulations to Shai and the Thunder. I saw they had a 600K turnout for their championship parade today. It looked like a fun time. I also thought it was great watching this really young, like a team full of guys my age, like try to celebrate. Right? None of them knew how to open the bottles of champagne and all that. Yeah, that was funny.
Did you notice the chemistry that they have with each other off the court? I mean, I think that's even just a testament with how well they do on the court. I mean, they're like brothers. It almost reminded me of playing in college again with your boys, where you guys are like boys on and off the field. And I mean, that chemistry really showed, and maybe it's not an accident they won the chip because they look like they're well in tune with all of each other. It feels like they're having a great time. It's their profession, but they're also seeming like they're having a great time. So I picked up on that too.
Yeah, absolutely. And if you haven't seen Jalen Williams' TikTok, and that's J-Dub I'm talking about, Jalen Williams, because there's 2 Jalen Williams on the Thunder. But if you haven't seen Jalen with a EN's TikTok, it's really funny. I recommend.
Yeah, no, definitely. We're going to get into a little bit of the Mag 7 again. We got to touch up on that. It's only right every week. Something changes. So we're going to reorganize some of those, see if it's justified to slide some of those down or slide some of those up. And then we'll get into some platform talk to do a little tour to market. The volatility index, if anybody is wondering, has not spiked, at least over the last 24 hours. So we'll touch on that, touch on some of these positions. I'm stuck in a couple of them, but we'll get it started. But the Mag 7, do any of the Mag 7 stand out? Let's start it that way. Do any of them stand out? We'll start from the top. We'll start at C tier and move our way down. But anything right off the bat standing out to you guys?
Well, I was going to say I think Amazon needs to move up. I needed to confirm whether we had already moved it up to S tier, but I'm a big fan of their expansion into the UK that was announced maybe yesterday or very recently. $54 billion US dollar, 40 billion pounds if you prefer it in that metric. Investment into the UK. Really, they're just aggressively expanding everything. You name it. Fulfillment centers, corporate headquarters, all of it getting built in the UK right now. I think that's a smart move from Amazon, but we already have them in S tier, so they can't go any higher.
Yeah, there was a little bit of a controversy. I don't know if you've seen it with, I'm blanking on his name, Amazon.
Bezos?
Jeff Bezos. Getting married in a specific country. Did you see the uproar? The uproar about that?
I did not. I've seen plenty of stuff surrounding this wedding actually, because mostly regarding his wife who swears she's never had any plastic surgery. Okay, but yeah, no, I haven't seen that specifically.
Okay, no, we'll have to circle back around to it. I just asked because AI nowadays, you never know. But it seemed like there was a little bit of an uproar in terms of where they were going to have their wedding. I think it was going to be out of the country. And, Jeff Bezos is a very liked guy, I would say out of the country. And there was a huge image of Jeff Bezos, I think, on the top of a parking lot where they don't want him to come here. They don't like a lot of the practices that he has. So just wondering if you heard anything about that. But other than that, how will that affect LeBron's legacy? No. How will that affect Amazon stock? I don't know. We'll see. But we can go ahead and touch on Amazon and see where Amazon has been over the last few days. AMZN, there we go. Nothing too much, not really following the volatility to the market, at least in terms of these price swings. But I mean, IV rank fairly low on Amazon. No other headlines really seeming like it's going to move Amazon to my knowledge, at least moving forward. So I would rank Amazon down a little bit. I think it's justified to pull Amazon down a little bit just because of the tear the market's been on. I would have thought the market would have dragged Amazon along with it just a little bit more. So a little bit of an underreaction in my eyes on Amazon. So I'm a little bit more bearish here on Amazon. I don't know what your take is, Gus.
Yeah, that's interesting. No, I think I still, I don't know. I mean,
yeah,
In a micro, like weekly context, I suppose I can definitely see where you're coming from. It hasn't been propelled as much as the rest of the market and some other companies that we're just about to talk about. I'd be comfortable moving it down to A tier just because of how short term this is. And in the long term, though, I do like the moves that they're making.
Agreed. I'm in the same boat there. I think I'm comfortable doing that if we do decide to do that, just because A tier is still valid. No second place trophies, but A tier is definitely still valid. So I'll give it to Amazon.
Sure. Yeah. Let's do it. Let's make the move.
Awesome.
NVIDIA.
Awesome.
What do we think about NVIDIA? We can just work down.
NVIDIA. By the way, my NVIDIA short call spread, if anybody was wondering, it never came back. If that needed to be said. No, Amazon's been going on an absolute tear, following the overall market a little bit here too. We were consolidating, really just taking out previous day highs, kind of just grinding up. Then we really got a pop to the upside and a continuation into today. So I feel comfortable leaving NVIDIA where it's at. The overall market is looking like it's gearing towards all-time highs. I'm not a proponent of getting short around all-time highs, so I feel comfortable letting NVIDIA fly here and keeping it in the tier that it's sitting in right now.
I agree. I think our policy with NVIDIA is just S tier until proven otherwise, and I don't think that anything
S tier
has
until
happened to
proven
prove that
otherwise. I like that. Meta, how are we feeling about Meta? Any personal gripes about Meta? Let's pull it up, see how they've been doing.
Yeah, no, nothing specific. Pretty similar share price movement to what we've seen out of NVIDIA here. I don't know if it's enough to make me want to move it up into S tier, but yeah, they're nearing all-time highs as well. And sustained through the little bit of volatility we had towards the end of last week, just fine. I think I'm comfortable just leaving Meta where it is. I certainly wouldn't move it down. There's been nothing explosive that makes me want to move it up. I think Meta is good in A tier, in my opinion.
Yeah, these IVRs have been getting absolutely thrashed. I mean, we keep talking about beginning April, but I mean, that still is relevant just because that happened to be the low that we've seen since. The market's been going on a rally since, and I mean, the IV's really been decreasing in a lot of these underlyings since then. So all-time highs, I don't know, this rebound was insane. We keep talking about it, but just wouldn't have expected for the market to recover this quickly. And all-time highs is a valid conversation now.
Yeah, I was part of a discussion earlier today where we were contemplating how the similarities that this has to the V-shaped recovery that we saw in 2020, and how there seemed to be this sentiment then that, we'll go get all-time highs and then we'll come back down. That'll be the end of this crazy tear. And that absolutely did not happen that year. We just continued to move up and make higher and higher highs. So I don't think that there's any reason. I mean, I'm sure that all-time highs will bring resistance as they always do, but I think if we push through those levels, I don't know that there's any reason that we see some kind of crazy reversal or breathing period or anything like that. The market seems to be doing what it wants, and what it wants is to go higher.
Yeah, the market is still proving to be resilient, no matter how aggressive or no matter how fearful those sell-offs sometimes feel in the moment. I mean, ever since the recovery of March of 2020, I've always kind of been the proponent, like, we never really got the sustained or justified pullback I believed that we should have gotten. And it's been 5 years now. So the market has absolutely been proven to be resilient. And this was the low back in March of 2020 that we were talking about here. We're on the weekly chart right now, so each candlestick represents 1 week. But I mean, this recovery was, took off like nobody's business. I mean, we had the gap down days. These intraday sell-offs were pretty massive, selling off from 322 on SPY all the way to a low of 286 in a day. That's a massive down week at least. So
yeah, and now
really
we've
similar to March.
Yeah, and now we've like way more than 2x'd that in 5 years, and it just kept climbing. I mean, that was the main thing, coming out of that recovery, is that everybody thought we would hit all-time highs and then things would stagnate a little bit and we had recovered, and that momentum just continued. And I don't know that this situation is all too different.
Yeah, no, not really. So far, NVIDIA, Meta kind of looking like brothers and sisters right now. What else do we have? Or how do we feel about Meta? I feel comfortable leaving Meta in the A tier just because I still feel good about Meta. Good. I still feel good about Meta. And then also it's following suit the rest of these underlying tiers. So I think it's valid to be in the A tier. What are your thoughts?
Yeah, no, I say the same. I think we leave it where it's at.
Awesome.
All right. Well, that moves us on to Google. You got any thoughts on Google?
The only thoughts I've had on Google recently is just how much
I want to move this
better
down more.
You want to move Google down more? Okay,
I'll open with that.
Yeah, go ahead. Go ahead and open. Let me hear your thoughts on Google. I was going to compare it to ChatGPT, kind of ranking where my personal behaviors are from what I've seen and just my long-term standing with Google. But before we get into that, where do you stand?
It's just, yeah. I mean, I think, I believe you just drew an Apple comparison, and I agree. I mean, it's just, we have this just stagnation going on. While the rest of the market rips, Google is finding ways to put in down days at
finding ways.
It is. It keeps finding days to put in down days and not go anywhere and just channel up very slowly. We just looked at, Nvidia and Meta, these A and S tier stocks, and they're ripping. I mean, it's just this, it's straight upward for the most part. You get your occasional slight red day, and then it's immediately engulfed by a larger green candle. And Google, it just hasn't been that way. They're in this awkward spot right now with AI stealing a lot of their search revenue, something that I think is going to continue. I will say too, they tried to do this like AI integration. Now when you Google something, there's like another thing. It'll say like, how at the top it says like all shop images, like all that. There's options. There's now one that says AI mode, and you can click that, and it will basically just kick you over to Gemini and have you talk to an AI instead of actually Googling things. I don't see that as being a reasonable resolution to this problem, especially with the lack of brand awareness surrounding Gemini relative to a Claude or a ChatGPT. So yeah, I just grow more and more bearish on Google. I mean, yeah, look at this chart. They die. I mean, yeah, it's been brutal. I'm not loving Google. I was long Google through the middle of this for a while, and eventually had to cut my losses because it just won't move. So I'm growing lower and lower on Google every week until they show me something.
No, I do wonder, if Google will ever kind of not kill their own product to let their other product flourish, but almost adapt their model. I know how you're kind of saying they have an extra tab now. The photo tabs, the links tab, I barely even click the tabs up there in the first place. That's like when I'm looking for something really specific, and if I'm clicking the other tabs, I'm really looking for something, or I'm lost.
Yeah,
or
and
I
the
don't
only
even
one
know
I'll
what
ever
I'm
use is
looking for.
images too. I'm never using
Right, exactly. 100%. So to your point, I mean, it's going to be really tough to integrate that. And I don't know if they're going to be able to successfully do it, because I think hitting the search bar kind of behavior is really attractive and is just muscle memory now. I mean, going to ChatGPT, it's like search bar, Google, search bar. So I wonder if Google will ever kind of adapt to applying their search engine model to something like a ChatGPT, but it's a risky move. I know Apple killed their own product when it came down to the iPod. The iPhone was flourishing. It was like, does it make sense to even have this iPod anymore? This does everything this can do and some. So I wonder if Google will ever kind of take that approach. But I don't know. Apple's a different dog though. So
yeah, and I mean Google too. Like I don't know. I think it's disgraceful that Google isn't more prepped for this. Also, I think that it's crazy how much of a concern this is all of a sudden that they didn't see this coming at the advent of chatbots and immediately start like devoting immense amounts of resources to making sure they would stay ahead of this curve. Because yeah, I mean now it's just. You sat on your hands for a year, and now you're looking like obsolescence on the search front. Obviously, Google isn't going anywhere. They're gigantic. They still have YouTube. They still have Waymo. They scramble everything pointed out in chat.
It's such a good thing they have YouTube. Goodness gracious.
Yeah. So still plenty of ad revenue getting kicked Google's way, but the search engine ad revenue was a major revenue stream for them, and I just see it continuing to shrink. So I'm down to move Google down.
I hear you. Hey, we got to look at the bright side. The grass is greener somewhere, Gus, and the IV rank is up on Google. That's different from what we've seen on Amazon and Nvidia. So depending on how you look at it, life is about perspective, right? If you're looking for some premium, Google's looking like a better candidate than some of the other ones we looked at. But I'm in the same boat on Google. I completely agree there. And we can actually move it down. I'm comfortable moving it down from B to C at least. I think C is still fair. It's not in the trenches.
Yeah, I'm inclined to agree. I think C tier is becoming fair.
Awesome. Well, we have Microsoft. Shout out to Microsoft. I'm more of a Microsoft guy than a Sony guy, so I've always been of the proponent of Microsoft. So shout out to them. Microsoft absolutely ripping to the upside along with the rest of the market, and you know what that means? Very low IV rank. That volatility crush has been crushing over the last couple of days, especially on these underlyings here. So, I mean, that's really all I have to say about Microsoft. I mean, absolutely ripping to the upside alongside the other products we looked at. So I'm not opposed. I feel a little biased, not moving Microsoft up one rank just because of how well it fits in the other categories of the others?
Yeah, I think we can give Microsoft a bump up. I mean, we were kind of just waiting for, they were having their own little bit of stagnation, and we've gotten the breakout. So yeah, I'm content moving them up.
Awesome. These IV ranks are absolutely slammed right now. So not much to do in there on the IV side, at least.
Yeah,
go ahead, put that up there.
To circle back to the Google point about YouTube streaming continuing to grow, yeah, absolutely. And I don't think Google's going anywhere. I pay for YouTube Premium myself. I'm giving Google $10 a month. So yeah, I mean it's not going anywhere. But
I am curious. I'm curious if, because YouTube Premium and YouTube TV is almost taking over the format of cable and things like that. I know we have all these other streaming services. I'm really curious if one of those companies will start to gain a monopoly on the market and will kind of become like the big dog cable providers, so to speak. I know there were multiple different types of cable providers, but it looks like YouTube TV and YouTube Premium is headed in that direction.
Yeah, Hulu with live TV is what I use on that front, like for anything I want to watch live or for all sports or anything like that. And that's another viable alternative as well.
What's that like? Is that like a guide, just like a cable service? I don't use Hulu TV or whatever it is. Okay.
They have everything in the world. It's the same as cable essentially.
Oh, really?
Yeah, you get you get national markets, you can get your local markets, your local news, whatever. If it's on TV. Yeah, Hulu got it.
Oh, wow. Awesome. Well,
Hulu's like, that's one of my primary apps, especially like during sports. I'm using the heck out of Hulu.
Noted. I just got a few notifications for certain streaming services. Peacock. I was like, yo, Peacock. Why did I have Peacock? Oh yeah, I was watching the Premier League soccer. All of these deals they're making with all these different streaming services. You got to go through all these loopholes to watch a specific game. But
it's insanity, and it's flushing people to piracy. But that's a conversation for another day. These services are going to kill themselves with all this diversity.
100%.
And I mean the diversity of the services. Nobody clip that. This is not a social commentary. I mean, there's too many damn streaming services.
I think that disclaimer was necessary. That is hilarious. Okay. We got Apple next. I like Apple. I've always been a long-term. I mean, who isn't? Apple's always been a big dog in the race, but trading at around $200 right now. Nothing too crazy about Apple. Kind of in the same boat as what was the other underlying we were looking at. Kind of in the same boat as the other underlyings that have a little bit of an underreaction from what I would have liked on this tear to the upside. Again, especially trading around all-time highs, just because the market has a tricky way of creeping around all-time highs and staying there for a little bit. So Apple's surprising me here.
Yeah, Apple. I mean, it's the same thing. I think it's justified to leave it where it's at. Is really going to be my end point here. We're just in the same boat with Google. This stagnation. This Mag 7 company that hasn't really managed to attach itself to this massive rally. And yeah, until something happens to make me change my mind, I'm totally content keeping Apple in C tier.
All right. Well, Apple better be lucky Gus is here because D tier was almost on the way. But I like it at C tier as well. I think it's a good spot.
I'm like such an Apple hater recently, but also like such a big Apple consumer. It's just the stock is just.
I was about to say just go buy an Android then, Gus. Go put your money where your mouth is.
Yeah, the stock. It's just been giving me fits. It won't move up, and that's an alarming thing. And with the way the rest of the market is moving up.
I hear you. I mean, it won't move. So we got Google in C tier. We have Tesla in D tier. Tesla's been a little volatile, but nothing out of the ordinary from what we've seen from Tesla. I'll let you go ahead and hear your thoughts on this one.
Yeah, I think Tesla is deserving of a bump up like one rung. I'm not super high on this, but the robo taxis have finally rolled out in Austin, and they're beginning to get their foot in the door in that regard. We're kind of through all of this Trump-Musk beef situation. So I think I'd be content.
What was all of that about? I mean, what that is like brushed under the rug already.
Yeah.
Maybe not for them too.
Just went away. I mean, they basically kissed and made up on Twitter, and then it was fine. So yeah, I'm content moving this up one tier. It's still lagging, still took a big hit from all of that it hasn't fully recovered from just yet. But Tesla's starting to move like stock again, and instead of this, crazy volatile news driven thing. So I think Tesla can go C tier.
I like it.
Robotaxis too. Robotaxi is going to take over the world. I was just thinking about this. Like 10 years from now, it's just all going to be robotaxis. This is crazy.
I mean, you really think so?
Well, yeah. I mean, it just makes sense. I don't like it. It's going to take away a lot of jobs, which is a real shame. But it just makes too much sense. Every company in the world is profit driven, and it's way more profitable to not have to give a cut to a driver. I think as this tech and infrastructure continues to improve, I think it's going to be Jetsons. I think we'll be zipping around in our driverless taxis.
Yeah, no, I mean, let me know whenever we're going to get to the Wall-E days. That's another goated movie. But I mean, that's a little bit more futuristic. Yeah, 11 years. I mean, insurance companies probably don't really like the idea of self-driving vehicles because, I mean, then that's going to reduce the human error. And I mean,
Wall-E is set in 2805. It's not going to take that long.
2805.
Yeah, we're gonna destroy this planet like 600 years ahead of Wall-E's schedule.
2805.
Yeah, humans evacuated 700 years prior. Okay. Humans evacuated 700 years prior. So 2105 is actually Wall-E's prediction for when we'll have to get off the planet. That is much more reasonable.
I think that's pretty reasonable. I can see that. I mean, I don't think we'll have some Wall-E type inventions for quite some time. So.
Somebody said until one of the robo-taxis plows down a crowd on the sidewalk, then it's over. Humans do that all the time.
I was like, who's going to say it? I was literally like, who's going to say it? Because not that long ago, but I
mean, humans hit pedestrians like daily.
Right.
All the time.
100%. I came across a video of this lady that was just absolutely distraught, accidentally hit a young teenager crossing the crosswalk. You could tell it was an absolute accident. But I mean, accidents do happen. And I mean, here in human error does happen. People have blind spots. And, I mean, some businesses do profit off of human error. So I think that industry would see a little bit of a skew in data if robo-taxis and self-driving vehicles really was taken over by the masses. I mean, that's one of the largest industries. So
yeah, and I mean, I think it's interesting to think about a future as well, where not even just the robo-taxis, but with full self-driving integration in society, where all of these cars could potentially communicate with each other. This is something I've touched on air before, but you could eliminate traffic pretty much as a whole if all of these cars could communicate with one another. And I don't mean like a CB radio. I mean the car computers are talking to one another. But when a stoplight turns green, for instance, the entire train of cars could all at once just go and stay 1 foot apart or whatever. Now, when a stoplight turns green, you got to wait for one person, the next, and it's slow. So yeah, I think there's a lot of interesting possibilities with this future, but also it's going to destroy a lot of jobs. I mean, a lot of taxi driver jobs. Anybody who drives for Uber, Lyft. I mean, I feel like most Ubers, Lyfts I get in, and that's their full time thing is they're doing Uber or Lyft. So it's I don't know. There's pros and cons. Such is true with everything, I suppose.
Yeah, I mean, it would definitely reduce the human error in that.
There's
and then
risk and reward, some might say.
There's always risk and reward. Absolutely. I like that. Nice little lob. But I was even just thinking, what would it be? More like a train station, but almost for like individual vehicles. Like you can kind of call it, maybe it turns into a subscription service one day. It's where you just kind of tap your card and you continuously pay the subscription service. If you want a vehicle to pick you up, drop you from point A to B, up your subscription if you want more stops within the month or more ride, whatever. I don't know.
That's interesting.
They're probably cooking something up like that right now, if we're being completely honest.
That's true. Yeah. And that would have to be like if you didn't own a vehicle, I'm sure you could do something like that. But I mean that already exists in some capacity. These Divvy and Lime bikes and scooters, they'll let you have a subscription to get yourself around. You can do Uber One. I think Lyft has a premium feature as well. So yeah, I mean we already are working on that infrastructure. It would just be taking the drivers out of the equation. I will pay more for a human driver. Yeah, that's a good idea.
Yeah.
It's going to be a gold mine for cabbies. That's true. It will. I think the total number of drivers will shrink, but the ones who stay around probably will be able to charge a premium just for being a person.
Yeah, 100%. And I mean, where I'm at or where I'm located, there's a ton of toll roads everywhere. And I pay this subscription because every time it tags your car, it knocks it off of that subscription that you pay for the month and then you replenish it. And I'm kind of just maybe thinking about those robo taxis as well. So robo taxis on the rise. That's what it's going to be for today.
Lime is going to IPO is the rumor. Man, Lime should sell. That's what they should do. They should sell to Uber.
Lime.
Yeah, the Lime scooters.
I'm surprised. Yeah. I'm surprised some of those other companies are still competitors. I mean, that industry was flushed with more competitors all at once.
It was Lime and Bird.
I got like 6 different apps.
Yeah, it was Lime and Bird were the two forever. And now I see Divvy is what we have here in Chicago. Divvy bikes and scooters. And I believe
Bird.
They're owned by Lyft, I think.
Okay. Yeah, I've just noticed there was one point where I had 4 or 5 different apps.
They're owned by the Chicago DOT. I don't know anything.
Okay, there we go. Well, we'll circle back around to those conversations this Thursday. Anything else to add before we hop out of here today, Gus?
Nope, nothing else. I'll get out of Victor's way.
Awesome. Well, that's going to wrap it up today for Risk and Reward. Hope you guys enjoyed. Thanks for taking the time to hang out with us. We will be back this Thursday at 4:30 o'clock Central Time. That's going to do it for Gus and Neat, and we'll catch you guys next time. Peace.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. It's like losses could have been catastrophic, and they're not. Cool. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so much.
Thank you, man. And I appreciate you holding on the line to say that to us. So thank you.
So I've been trading for about 5 years, maybe 8 to 5 years, and I got in the options world because I wasn't making enough just holding long equity. You know, there's not a lot of strategy. It's just sort of like buy it and then pray it goes up. I found Tasty Live from my friend, and I started looking at the YouTube videos. My favorite part about it was just that there was math, there was probability, it was something you could consistently rely on. Once someone gets the right information, which they provide on Tasty Live, they can really change their financial situation for the better. Consistently, not, oh, I bought a stock and it went way up one time, but how can you do it consistently over and over? And with Tasty Live, I was able to do that.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it's Tuesday, June 24th, a little bit after 5 p.m. Central Time. You know what that means? It's time for Tasty Live's evening show. A little podcast, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world, and they're making us work for it. More on that in just a little bit. Before we go any further, let's announce, or introduce, I should say, our very special guest, one who needs no introduction, but I shall try anyway. The one, the only, the global head of macro here at Tasty Live, the big brain, Mr. Ilya Spivak. Ilya, how are you, my friend?
I'm good. My voice is gone for 2 days now from having been to a Metallica concert and screamed it out, but otherwise, all is well.
Are you a headbanger? Like, do you get in there? There's mosh pits at Metallica, right? Are you in those mosh pits?
Those mosh pit tickets are like 4 times more expensive than anything else on the board. So no.
Why are they more expensive? Does it come with health insurance? Does it come with health insurance?
that would be great. If they came with temporary coverage for when you get your skull kicked in, that would be great.
Or at least a bottle of Tylenol that I'm gonna need for the next few days.
Seriously. I try not to headbang too hard anymore because it's not great for the old neck.
So what does Ilya Spivak do at a Metallica concert? You just kind of are you just kind of swaying?
It's a controlled head bop. It's a head bop acceptable to the mid-40s.
Right on. Well, let's do this. We got a lot to talk about, so let's get into it. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, do yourself a favor and go get them. But if you want to be part of I think this little conversation, this little chat box on your screen, there's only one place to do it, and that is heading over to the evil Google YouTubes and subscribe to the channel. And from there, you can, move those phalanges, those metacarpals, bash your face into the keyboard, do whatever you can do to create random ass characters and spoof the Google algorithm into putting us in front of as many people as possible. Emmett Morrison says, I can see Ilya at Metallica dressed in his finest Adidas tracksuit.
Not the venue.
All right, my friend, let's get going. Up and away they were today, 6,141.50, and crude oil in the mid-60s. Did you have either of those two things on your bingo card as we came into the week, Ilya Spivak?
I thought crude oil, yes. I thought stocks, no. Crude oil, obviously the levels were, I thought, relatively straightforward. If you notice, we land on the top of a range in crude oil where we sat for quite a while. So we've sort of done the full round turn on these geopolitical tensions and come right back to where we were, right the top of the range where we were consolidating since early April. Now, did I think we were going to get here that quickly? No. I didn't know what to think. But when on Monday, it seemed like the counter volley from Iran was very measured and telegraphed ahead of time, and the president made a point of coming out and saying, we're not going to retaliate to this. We see it for the face-saving move that it is. By the way to say the quiet part out loud. But we get back to essentially a kind of even keel on oil. I didn't think we'd get here that fast, but I started fading the vol there already by midday Monday, and sold calls in MCL, essentially looking for this thing to recede both in price and in vol. It's done that. I'm getting a little antsy now because we're approaching support. For stocks, I thought it was very telling that we hadn't gone anywhere since basically the CPI report 2 weeks ago. And we kind of shrugged off the war and shrugged off the resumption of the U.S.-China détente and shrugged off this and shrugged off that. It seemed like stocks were sort of waiting and looking. They're not waiting and looking anymore here. Today, we clear that high. So I got out of my puts here and just went hands off on stocks, because after today, it seems like the path of least resistance is to retest the highs from December of last year. And we'll see what happens if we do that.
S&P 500 up more than 1% today, talking cash. The NASDAQ up 1.5%. The Dow Jones up 1.1%. The Russell up 1.33%. I said yesterday, when they, effectively on Sunday night, when we opened up, in a few hours, like late that evening into Monday, they had bought them all the way down to just like 1/3% lower, 1/4% lower. I'm like, this thing, I put it out on Twitter, like, this thing wants to run. This thing wants to, it's just, it seems like there are so many people caught off sides here, and you give them a little bit of discount in any underlying instrument. A lot of people are playing catch up into the end of the quarter, bro. If you panicked and shit your positions at the beginning of April, you're playing 3 months of catch up, as like all the Mag 7 stocks ran on you 40%, and you got to figure out a way to play catch up here. And it seems like any small little discount, the market seems to be using it as an opportunity to get long. And I'm kind of curious, does all this change? Does all this change at the end of the quarter? Like, do you get a reset at the end of the quarter with people no longer chasing for the quarter? Do you sort of see that, or do you not play that game? Or think in those terms?
I don't hang a trade on that kind of thinking in isolation, but I think you'd be silly not to understand that there are waypoints on the calendar that have to do with professional money managers reporting of their P&L, and that these things matter just for the way that people manage capital and manage risk. I mean, that's obviously the case. So I think when you look at it, sort of like saying, well, do I think that end of quarter flows are going to outweigh and overshadow anything and everything, and it's a given? No, that would be a crazy thing to say. But do I think that they could be something that forestalls a greater reckoning, or otherwise some kind of a shift in thinking that basically nobody wants to mess up their quarterly performance number here and would be much more interested in reevaluating where their portfolio is once they're sort of through that snapshot at the end of the quarter? it's not a crazy idea whatsoever. I think what makes it not a crazy idea from a macro perspective and sort of what might be the catalyst for something like this is actually what we've been watching all week in the economic data and in the Fed dynamics, basically all since Monday, at the same time that this Iran story is dominating the headlines and nobody's really paying attention. So we got the PMI numbers. They're okay. They give us an economy that's had a level change in growth. So second half of last year, let's say, if you take the PMIs as your barometer, second half of last year, you have very strong U.S. growth, mainly powered by a very strong service sector. At the start of this year, you had a growth scare, and you've had a kind of level change in the first 3 months of the year where growth dipped, but it's now seemingly stabilized a little at a lower level, but not a negative level, and not anything that would tell you that sort of things are coming off the rails in any kind of a meaningful way. And this sort of echoes what the Fed is saying. They're saying, look, inflation is closer to target than not. Unemployment is historically low, or by historical standards is low. And why would we jump this way or that when that's the economy and we don't know exactly which side of the ledger we're going to end up on? There's no reason to think that this is anything but wait and see mode. So you get that data, you get the Fed with the same message when Powell speaks today, and the bond market says, no, you're wrong. The break-even rates fall, bonds go higher, the pricing in Fed funds gets more dovish. Last week, the Fed said, we're only doing one cut in 2026. The market now has a 50-50 chance of a third, and 2 are baked in. 62 basis points for next year. So there is disparity here clearly. And when you lay that over with Europe is at a standstill, the PMI data confirms that. China is at a standstill. It hasn't gone anywhere in years now. It's going on 8 consecutive quarters of economy-wide deflation. So the U.S. is again the single point of failure, just like last year. And now it's a lower growth setting. So you're sort of inching closer into discomfort territory. And if the Fed is wrong and the markets are right, then the risk is to growth, not on the inflation side. The Fed should be cutting and isn't, and are going to realize that, or Fed funds futures wouldn't be doing what they're doing. We've talked about this for a few weeks now. They're pushing rate cuts further out, and they're saying there's an exchange rate here. There'll be more of them because they're later. So at some point, the market's going to care, but it's not today. The bond market cares.
What if you're wrong, Ilya? Like, in other words, you've had a relatively, and I mean this with all due respect, you've had a relatively negative perspective on asset prices for a long time. And I wonder, man, how does one reconcile the narrative that they tell themselves and others with price action? How do you reconcile that? And at what point, or are you just so confident that your view of the world is accurate and it's just the prices that are wrong?
I think the price action is the only thing that matters. And as a trader, you cannot live in your narrative no matter what you think, which is exactly why I abandoned my shorts today when we got a close above a higher high, even though I kept my shorts through all the good news coming in because the price action didn't set a higher high. The price action is the only thing that matters. It's why I was short at the beginning of the year through the sell-off from mid-February into early April, and then flipped long and held it long for a while there. Not nearly long enough. I missed about 50% of the rebound. But I was already long for the pause on Liberation Day. So I think, and that's having zero confidence in sort of the overall risk on story. I think you have to trade the price action. I think if you trade the narrative and you're fighting markets longer than it makes sense to fight them, and this is where risk reward and risk management is key, you get run over. You're going to lose money in markets, but you have to lose it in a controlled, risk-defined way. So, for example, I've been short dollars all year until on Friday. Well, last week, actually, I flipped the whole card over and got long. But that's been really the way that I financed the bearish, this most recent bearish view on markets from April onward that hasn't worked out because the other one did, the bounce did. So this obviously is a dent to P&L, but with the dollar having done what it's done, with the bonds having done what it's done, the portfolio has done pretty well. It's up on the year. So I think you look at the whole as a macro type of participant in markets. If you're looking at the whole of what you're doing, if you're managing risk, if you're minding risk reward, you don't have to be right. You have to be less damaged when you're wrong than profitable when you're not.
Let me double click. 100% I agree with everything you just said. Let me double click on something. So I guess where I think there's been two points that I think I've heard you focus on. The first point is that there's a bunch of debt that needs to get rolled over, and that's going to have a meaningful impact at some point. And I agree with that. I just don't know to what extent, and I don't know to.
No, neither do I.
I wouldn't know why that wouldn't already be priced.
Well, and the markets clearly don't care at this stage.
Right. Then the second one is that these tariffs are, 5 times the previous level, and that's going to have a meaningful impact, which I kind of disagreed with because I felt the market had priced a 10% universal tariff at the outset. The crazy reaction was due to the fact that we didn't get a 10% universal tariff. We got this other thing to create leverage, but by the end of this whole thing, we're probably going to end up somewhere at where the market priced initially, which I think the market can probably stomach. I don't think it's that material at the end of the day. It's going to bring in like anywhere from $200 to $500 billion in annual revenue. I just don't think it's that substantial one way or another, but I think you feel that is going to be a really big factor in consumption in the next 9 to 12 months. Is that fair?
I think for me, it's less what I think, it's what I see. Okay. And what we saw in the first quarter was the weakest consumption component or consumption contribution to GDP in almost 2 years. We've got to go back to the second quarter of 2023 to get something comparable. That's just consumption, household domestic consumption. Obviously, there's a ton of fuzz in the GDP number with imports and inventories from the front running of the tariffs, this, that. All that stuff collectively is barely a blip. Were it not swinging with these crazy, like 40% up in imports. It's got to swing that much to influence GDP numbers because GDP is 68.5% consumption. So you see consumption slowing. You see retail sales after a front running of automotive tariffs in March fading back. But at the same time, you see consumer confidence in these latest University of Michigan numbers definitely rebounded in June. And so you're reading the tea leaves and you're saying, okay, will the consumers come? Because that's not just the only game in town for the U.S. economy. By extension, it's the only game in town for the global economy. Because the U.S. is the only meaningful pillar of global growth that's actually growing. The Eurozone and China are not. So when you look at this from that perspective, it's not that you're saying, oh, well, I'm certain this will be bad. Nobody knows that. The Fed is telling you, well, listen, we have no idea. We know that historically, tariffs give you a boost to inflation, which can be kept a one-off if you're careful and it doesn't get into expectations. And second, you get a negative hit to growth because higher costs erode demand. And again, maybe you benchmark that and keep that to a one-off. Okay, when? The tariffs are announced in April. And by the way, that what you're saying about the level, were it to be certain, I think you even saw in the price action on the day of. Because when the president came out and said it'll be a baseline 10% tariff, markets ripped higher. It wasn't until he pulled the foam board out later that they were like, wait. I thought you said 10. You just said 10. What's this? There's all kinds of rates on this board.
That foam board was hilarious.
What's happening with the foam board? You just said 10. So I think you're right. I think the markets, were they to know that there is a forecastable level, and this is the level, they would like that.
Let's talk about the SEC.
The question is not about what markets like, right? The question is, do consumers come? Because if they don't come, the markets are going to learn to not like it.
Yeah, I think that's fair. Let's talk about this SEP, man. I'm sort of really curious to get your take on this. We haven't had a chance to sit down and discuss it. And
we're a fun exercise, this SEP.
Well, we're nerds, so our definition of fun is not what everyone else's definition of fun. I'm guessing we've got a group of people here watching that might think this is fun as well. So I was dumbfounded by this SEP. I was dumbfounded by what they put on paper. I was dumbfounded by the market response, honestly. So let's go through this, man.
Yes.
They put a piece of paper in front of the world, and I always joke about this piece of paper. It's like, if you want to know what won't happen, if you want to know what most certainly will not happen, look at this piece of paper. But
unless it's September last year and they ask Powell with 50 basis points cut.
Oh, the Fed funds
more.
projection.
Yeah.
Yeah, the Fed funds projection has been all right since like 2022.
Yeah.
Yeah. All right. So the growth, they decreased in 2025. I'm going to focus a bit on 2026 here, but they did decrease growth for 2025 to 1.4% from 1.7. But they also decreased their expectations of growth for next year in 2026 down from 1.8, which would be about trend growth, to 1.6%, which is under trend growth. Yeah. They increased the unemployment levels for 2025 and 2026. They jacked them to 4.5%.
Yeah.
They increased inflation for 2025 up to 3%. And again, what they're doing here is kind of truing up where their previous projections were with really what reality is. And they increased 2026 inflation from 2.2 to 2.4%. And they basically, what they do, they took away a cut in 2026.
They took away a cut. They extended the timeline. So now instead of getting to 3.4 next year, you get there in 2027. So they threw a whole year into the timeline.
Right. And so I'm like, okay, lower growth, higher unemployment, higher inflation. Somehow you're going to combat that higher inflation with just not cutting as many times with one less cut. I'm like, what? This is to me, this is a joke. This is not real. This is not serious. This cannot be serious. What did you think when you looked at this?
So I think when you put this together with how they're talking about the tariffs, this makes sense.
Explain.
Imagine that you have a normal kind of trend in growth, right? And assume, let's for a second just take slope out of it. You just have a horizontal line, and that's your normal growth rate. And then you say, okay, the tariffs are coming. We think they're going to be bad for growth, but we think we can keep it to a one-off. Where they come, they reflect as higher costs, and then as long as they don't stay in higher costs, the economy digests it, we get to a new level, we even back out. It's an episode. It's not anything that extrapolates. As long as we keep inflation expectations contained. You heard what Powell said on this today. He said, in order for us to ensure that employment holds up, we cannot let inflation expectations out of the bag. And so he's mixing mandates here for a reason. He's telling you that we need for this inflation shock to be a blip and not something that then goes into expectations of higher inflation downwind, which then impacts consumption downwind. He wants for people to go, okay, we're going to wince here for a quarter or two, and then we'll be okay. As opposed to something that extrapolates higher and higher inflation. And because the last time we updated these forecasts is March, then you get the announcement of the reciprocal tariffs. Then they're paused for 90 days. Then the Fed meets in May and says our expectations for growth and inflation have moved in the wrong direction on both, but doesn't actually give you the updated forecasts. All of this becomes very predictable. So if you have that flat line that is normal growth, what the Fed wants is a pimple in the line, but not a change of slope or not a change of level. And so in this sense, what this is telling you is we thought the pimple was going to appear in the line earlier, and now it's going to appear later because of this 90-day pause, because of how long it's going to take to actually see what this looks like. And so we now see the hit to growth happening later. We now see the bump to inflation that's going to make the hit to growth happen later. So we now are going to give you fewer cuts next year because we expect to be riding you out through containing inflation expectations already then. Whereas we thought we maybe could do it all this year. That's how I read this.
If you imagine that this projection ends up being true, is it risk positive or risk negative, and why?
I think this view of it is risk positive because it envisions that the economy basically slows to growth but doesn't fall away, that you don't need to cut aggressively. In fact, you can actually afford to hold rates a little bit higher than you thought because the economy is fine, and you can afford to coast through what is a surface level inflation spook, right? Look at the path of inflation. The Fed says this year is the peak. Then you go back to 2.4% next year. CPI just came out at 2.4% right now. In other words, what the Fed is saying is there's an inflation spike somewhere at the back half of this year, and if we're careful and we don't overreact, it'll dissipate by itself because it'll be the tariffs as a one-off. And so, I think you read this and you go, well, it makes sense what they're saying. The problem with what they're saying isn't that it doesn't make sense. The problem with what they're saying is that the bond market has looked at this and said, yeah, sure, except you're wrong.
Yeah, but the bond market always does that. The bond market's been predicting way more cuts than we've actually gotten for the last 4 years, 3 years.
Unless they don't. So we saw that last year, right? Where the bond market goes, you got to cut, you got to cut, you got to cut, you got to cut. And then in September, the Fed goes, here. And the bond market goes, whoa, that's way too much. And then there's a big bond sell-off, and the market goes, yeah, you guys way overshot. So to me, the most interesting bit is all this liquidity in the bond market is saying inflation expectations are biased lower, not higher. Fed funds futures, which are derivative of bond markets and sort of the overall rate structure, are telling you these guys are going to do 2, maybe 3 cuts next year when they think they're going to do 1. That's adding up to the market saying the Fed is going to have a growth scare before they think they are.
Mm-hmm.
And the risk to asset values, the risk to stocks in that scenario, which, by the way, are back to their starting range for when the markets were kind of figuring what's going to happen. We've essentially reset. Now you get a situation where the markets go, well, if something does happen, and it is sooner, these guys' calendar means that they're going to be reluctant to act in time. And once again, 1 year forward rate cut expectations are starting to blow out. We saw this movie last year from mid-April until mid-September.
Let me ask you this. I'm going to switch gears just a little bit. Maybe we'll ruffle some feathers here. I was sort of fascinated by this tweet the other day. There's been a ton of them. But this one specifically, bro, this one I am fascinated by. So President Trump puts out a Truth Social post, and it says, everyone, keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it. This is on June 23rd, so yesterday. And it's like, bro, are markets effectively, are we the new soldiers? I mean, we are effectively fighting an economic war. And so the idea that the president of the United States could say, everyone, keep oil prices down. I'm watching you. Like, to me, I was like, I cannot believe that somebody's commanding markets to keep oil prices down. I mean, are we assuming this is effective? And then oil tanks. Crude oil tanks down to 65.
Yeah, but it doesn't tank because of the tweet.
I get it. I'm get that correlation is not causation, but I'm fascinated by just the idea that you can call out to the markets and say, everyone, keep oil prices down. I'm watching. Did you see this tweet? And what do you think about the idea that the president's commanding the soldiers of financial markets to do his bidding?
I didn't see this one. I saw a lot of them over the past several days. Obviously, all the big announcements have come that way. The president is nothing if not a marketing genius. You now have to watch Truth Social if you want to know if the U.S., Israel, and Iran have a ceasefire on the table or not.
Yeah.
What a thing here. Talk about monetizing one's position. I didn't see this one. I don't really take it very seriously. We've had, if you were to say that let's give this lots of weight, and let's say that this is like Reagan telling Gorbachev to tear down the Berlin Wall. Did it get Gorbachev to tear down the Berlin Wall? I mean, presidents say things all the time. That doesn't mean those things, like everybody snaps to attention and goes to do it. Oil markets don't even have a spot price. There is no spot price of oil because there's just so many different spot prices. There's just the two main futures markets benchmarks, but there's a gazillion different prices of oil, different crudes, different grades from different locations. Who's the president talking to? So it's a sentiment and it's a vibe, and it sends a message that sort of gives you some view into what the policy thinking at the White House is in terms of like, here's what we'd want, here's what we don't want. I don't think it means anything other than sort of entertainment value.
I agree, but I'm not saying that there's causation here, Ilya. When I'm speaking to the mentality of
the breaking of norms.
No. Just imagine if you come out and you say, today's a good day to buy stocks, right? Mm-hmm. Then a few hours later, you launch the S&P 500 up 10%. And now imagine that oil price spikes. You know that's not good for you. You know that's politically can create problems if that high oil price is sustained. And so now you go out and you speak to the markets again. And you say, everyone, I'm watching you. Keep these prices. It's just the mentality of this, that you think you're this like all-knowing, all-seeing hand who can move markets one direction or the other. That's what I'm speaking to, Ilya.
It certainly creates a level of optics. Whether you choose to take those optics seriously or not, I suppose, depends. I think, for example, you get comments saying Iran's entire nuclear program has been destroyed. But today you get reports that that's not the case.
Right.
And by the way, not in any kind of crazy, nefarious way. There was lots and lots of conversation that, for example, sites like Furdo are so deeply buried that you can't destroy them. You can destroy the entrances into them and make them inoperable rather than destroyed. And that this is really the only way that you can do anything, but that's a meaningful step. And that's what it seems to suggest now, is that these things have been made inoperable, not destroyed. But the language makes you think. And I think you see that over and over again. There's just a level of hyperbole that I think you have to take as given now.
What say you about oil from these levels? I'm sort of curious about two aspects of this, not just oil price, but the defense stocks as well. It looks like Palantir crept a little bit higher today, while some of the more traditional ones have lagged behind a bit. But just to focus on crude oil for a bit, how would you be positioning at this point?
So at this point, I was saying earlier, I sold some calls to extract some vol and basically bet on the price receding in MCL. And I gave myself all kinds of durations just in case. So I'm in the MCLU contract here. And I'm still in it. I'm a little bit concerned that it might have run its course. that basically the up and down in the geopolitics is there now, and we're going to sort of now wait for next steps. And if the bond market is telling you that you have a growth scare, Fed funds futures are telling you that you have a growth scare, then it might invariably show up in oil, but it's certainly not there in stocks, and it's certainly not screaming out elsewhere. So, copper, say. So, for now, I'm just going to sit here and wait. I think the range that we had there from April through May has got a top on this chart here around 62, where you got it CLQ. So you're basically there now. So you've kind of reset the geopolitics spike, and you're back to sort of the upper end of where fair value has been since early April, since you kind of set those Liberation Day lows. Now let's find out. I haven't gotten out of my my short here yet, but I did MCL this time rather than USO or some sort of other ETF thing, which I might usually look at just because it's easier to kind of manage size. Because I want the opportunity to get out after hours, if need be. So I'm watching this very closely.
I think I'm with you. I don't know that there's a move to be had here in crude oil at this point, but I do think it's creating a discount in energy stocks, and I still like energy stocks. So I think they went on a little bit of a run, obviously, with the premium that was put in crude oil. I think some of them are now taking a little bit of a breather, and I think that's for me, not necessarily telling anybody else what to do with their money, but for me, that creates an opportunity to get back into some of these things at a little bit of a discount. I still think these things are trading cheap. I still think only 3% of the capital in the S&P being allocated to energy and 5% being allocated in total to energy and utilities. I think that's wrong. I think the market over time is going to normalize that misallocation of capital, over-allocation to tech and under-allocation towards materials and energy. So I sort of like this setup, this pullback in crude oil, if for nothing else, to get into energy stocks at a little bit cheaper price. I know that's not the game you play. You play at more macro level, not individual sectors or industries.
For the
but
most
I figured I'd put that on the table.
For the most part, I can get into sort of geography-specific things sometimes. So like the Japan ETF, or actually, oddly enough, I'm actually net long equities here because I got out of my exposure in the short side of the NASDAQ and the S&P, which leaves me net long EWZ, the Brazil ETF. And there I bought a leap, so I'm giving myself lots and lots of time. But interestingly enough, for all my naysaying about stock markets, I am of all things net long now. Which by the way tells you it's the price action I care about.
If you talk to any of these guys or in the chat, they'll tell you I've kind of been low-key obsessed with the home builders for the last couple of weeks, and I find it fascinating. Today, XHB was up about 1%. A lot of the home builders traded to the upside. I find it fascinating that comes on the heels of, the home price index. I think there were two housing numbers today, but one of them was the Case-Shiller home price index. I think the other one was like the FHFA or something like that, but down 0.3% on a month-over-month basis. What's your view? I know you might not be trading the home builders, but I know you keep your eyes on all of this data. What's your view on sort of the housing market right now, the housing data, I should say?
Housing data has been increasingly soggy recently. And maybe, just maybe, what this is starting to reflect is the part of disinflation that the Fed has really struggled to achieve, and maybe it's finally achieving it. So we talked a little bit about this last week, this idea that what the Fed's 2022 rate hike cycle did was it basically locked up the housing market and pushed out both sellers and buyers. First, sellers, because the average locked-in 30-year mortgage rate in the U.S. was much lower than where ultimately the Fed sent the 30-year rate with those rate hikes. I mean, we got as high as 7% on the 30-year, even just the beginning of last year, and we're already off that to 6.8. But in 2023, we were looking at almost 8%. So if your average mortgage locked in the U.S. is 4, those people locked in at 4, they're not going to want to sell if they can help it, so they can refinance at 8. That's nobody's idea of a good time. And so sellers try not to sell. Most inventory in the U.S. is about 4-to-1 existing versus new homes. We sort of famously don't build enough homes in the places where we need to build them. And so what that's meant is really low inventory, and so the prices are sticky, and so the buyers don't come. There's not a price adjustment down. Obviously, last year, in September, the Fed massively cut rates by 100 basis points, basically from September into the end of the year, 50, then 25, and 25 again. Mortgage rates are, in fact, starting to kind of respond begrudgingly. Not sort of as much as they could. They hit a low in September, and we talked about this. When the Fed finally did the cuts, the markets went, oh, that's too dovish, and adjusted. So they're a little bit off those September lows. They got as low as about 6, and now we're, about 6.8. So maybe what's starting to happen is when you've come down from 8 to 6 and now kind of sitting below 7, some of this is starting to slowly unwind. And as the Fed eventually cuts again, it will unwind more. And hopefully all this talk about building more, because it takes about a year for, on average, for a given unit of housing to get built. Maybe all of this starts to actually occur, sort of expecting that demand will come as rates fall, right? If you're a home builder, you might say, okay, the Fed is pushing rate cuts out, so rates are going to be lower in about a year from now. Okay, I should have inventory ready for when those lower rates get buyers to start thinking about maybe they want to come into this market. And in the meantime, you sort of see this slow adjustment in sort of unlocking the price a little. So if you look at the latest, I mean, obviously we just had Case Shiller out today. That's the year-on-year rate, and it's still a positive rate. I mean, it came out at 3.4%, but it's also the lowest that we've seen since
the year over year was
August
positive, but I think the month over month was negative.
Right. The month over month was negative. It was well, almost. It was up only 0.8%. And so that's a slowdown versus the
unadjusted
prior month.
Yeah, you're right. The unadjusted, the adjusted number was negative.
Yeah. So again, like you in the year on year, you see that clearly, kind of when you take the noise out of it, since a peak in, let's call it early 2024, the pace of gains in house prices has gone nowhere but down. They're still growing, but at an increasingly slow rate. And if we're seeing the housing market start to unlock as mortgage rates come in a little bit and people have seen now a few years of higher rates and they start to acclimate and start to feel like maybe this is the new normal or closer to it, so there's not as much sticker shock. I mean, housing markets take forever to make this adjustment. So maybe what we're seeing is the beginnings of some stirrings here. And maybe for home builders, given the Fed outlook, that means they need to get to moving on inventory. But again, in the US, it's existing home sales that are the big kahuna. Unless we really do have a real build out. But that doesn't mean that home builders can't be starting to perk up ahead of time.
Yeah,
the thing to worry about is if the bond market's right, and there is in fact some economic downturn, and rates go down for wrong reasons, not maintenance reasons, and then demand gets pushed out further into the future.
I think so. So many good things there. So let's talk about good reasons versus bad reasons. I think like the September cuts, people would have looked at that as a maintenance cut. And look what happened to the long end. So I think you're damned if you do, damned if you don't. If you cut for maintenance reasons, I think the long end keeps lifting. I think if you cut into a period where people are a bit more concerned about growth, I think those cuts actually have the intent, I don't want to say the intended, but they have the expected effect on the long end, which is long end comes down along with the short end of the curve. So it's on one end, yes, it's not great because you expect less growth, economic growth in the future. However, it's like, well, what do you want? Do you want higher long end rates or not? And maintenance cuts, you're going to get higher long end rates, in my personal opinion, or the long end rates are not going to come down. But if you're cutting into a growth slowdown expectation, those long end rates will come down along with the Fed funds rate. So it's like you got to pick your devil in this particular scenario. And I'm fascinated with the idea, the potential for home prices to be coming down and that becoming more of a mainstream thing, because nobody's focusing on it. Nobody's talking about. There are a couple of hot markets that are popping right now, but nobody seems to be talking about this aspect of the market right now. And I think you get a couple of scenarios where home prices are meaningfully deflating, and I think people start talking about it. And in that moment, to see home builders doing the exact opposite. That home builders would be rallying at the moment where people are starting to talk about home prices actually coming down, because there's two ways to make new homes more affordable, Ilya. There's lower rates, or you just change the price of that asset. And if the prices of that asset come down and are becoming more affordable, even if rates aren't moving, that's still a potential reason to change your demand forecast and potentially put more supply out there. And I don't know. I'm fascinated by this
isolation. They happen at the same time.
I'm fascinated by this setup in home builders. I could be way early. I could be completely wrong, but I don't think. I think if I'm wrong, these things are trading at like 5, 6, 7, 8 multiples. They don't tend to trade with high multiples, but I just think if I'm wrong, I'm not going to get murdered. I don't think. Famous last words.
I am sympathetic to this idea. Because I think a lot of what the macro risks exist on a different time scale. Because again, housing is devilishly slow. Like, consider that stocks bottomed. I mean, the last time that we had a really big housing spook, right? Stocks bottomed already by March of 2009. The housing market doesn't bottom until late 2011, early 2012.
Yeah.
It's on a different time scale.
Mm-hmm.
It takes a really long time for things to adjust. So you get these pockets, for example, 2011, 2012, where stocks are just bottoming and rates haven't gone up yet. And so it's this magical time when it's the perfect time to be a buyer of housing. And then you get the flip side of that. So you get 2022, 2023, where rates are going up, but prices haven't adjusted down yet. And so it's the absolute worst time to buy housing. Because again, these things exist on different time scales.
Mm-hmm.
So when I look at the home builders here, I'm very sympathetic to the idea that what their outlook is basically a 12-month forward window on where demand is going to be. And given how slow housing is going, I might be concerned about the broader economy. I might be concerned about any number of things, but the housing market has been slowly creaking through a top for a few years now.
Mm-hmm.
And as it creaks into a top, and as rates creak lower slowly, whether for maintenance reasons or otherwise, and that echoes into mortgages a bit, as it has a bit. I mean, it's a 30-year rate, so it's not terribly sensitive, but it's there a bit, right? We're down from 8 to 6 and change, and have been as low as 6 or so. So as that happens, the supply-demand imbalance in this market starts to change. And if you're a home builder, you see that 12 months in the future, you're going to start to do more stuff. And that economic activity should then appear in the price, and it should appear there earlier than you report it because the markets have sniffed it out. Markets are ever forward-looking. From a technical perspective, I don't think it makes sense for me to be long here because it seems like we're basically at range resistance. But if you got any kind of a meaningful breakup here, I'm not opposed.
That's where this, for me, it's not like a trade. You know, it's not like a 45-day cycle. It's just I'll go through these periods where I'm like, I'll accumulate a theme that I like a year, 2, 5, or 10 years out. And I don't know if this is the right timing for XHB, but I don't think I'm going to pick the bottom. I think we did pretty well. I think we picked the top in September, but I don't know that I'll pick the bottom here. I just think I'm getting pretty good value in this. I like energy stocks. You know, there's a few themes that I like.
As a leap idea, it certainly makes more sense because clearly you had a down move that is no longer a down move. Now it's a sideways consolidation. So,
right.
And if you have a macro narrative that I think we generally agree on, that the path of least resistance from here is higher, not lower, then you give yourself enough duration, it starts to make sense.
It's the name of the game. Let me ask you, when does the market unclench? When does the market unclench from this like aversion to U.S. dollar and to U.S. treasuries and the preference for gold and Bitcoin? And that assumes that there will be a moment when that unclench happens. That might be a poor assumption. We might have just found the market over maybe the last couple of months here, last 6 months. It almost seems like they're treating gold as the new reserve asset, with Bitcoin as this sort of kicker. Your thoughts here on whether or not you think that continues to be the case out into the future, or whether or not the market unclenches from this fear of U.S. Treasury, U.S. financial assets, and U.S. dollar?
And I guess I don't quite diagnose the symptoms the same, but obviously I've been short the dollar basically since late last year going into this year, and I only just flipped over the position on Friday. So I've been on board, and in fact, what has made me most of my portfolio returns so far this year has been this idea. I mean, I've been just short the dollar against everything not nailed down. And that's worked. So, I mean, I guess my diagnosis here isn't so much that what the world is saying is that there is some kind of a structural break from a US dollar-based commercial order, or from the Treasury being the quintessential risk-free asset in portfolio construction all around the world as a benchmark. I don't think those things are at risk, but I think there is a very wide spectrum between the U.S. is doing better on that dashboard or worse, rather than it being a binary thing where either everything's okay or the world has moved on from USD-based assets.
Of course.
You can clearly see that the dollar has taken a shellacking. And that doesn't mean that it's going to get replaced or that there is a replacement. It won't, and there isn't. But in any kind of near-term sort of investable sense. But clearly the rise in term premium in bond markets suggests that the markets are assigning greater risk to US-based assets, and we've seen that show up. We've seen that show up in higher long-end rates. We've seen it show up in a weaker dollar. It does seem a bit overcooked. I don't think it's a theme that goes away, because I think the overarching theme is deglobalization and a loss of confidence in there being a kind of supranational rules-based order with a really big Uncle Sam gun at the other end of it saying, you better fall in line. I think Uncle Sam has become broadly disinterested, echoing, by the way, public sentiment, in constructing some sort of a U.S. policed set of norms. And what that's done is it's created more risk, it's created more uncertainty, it's created a kind of unraveling of some norms on commerce, on all kinds of things. And I think on a long enough historical time frame, this is the correction, whereas the trend, sort of human history-wise, is toward more open markets, more globalization, more commerce across geographies. But we're in a sort of structural cycle where we seem to be backsliding somewhat on sort of the late 80s through COVID globalization kind of build. And I would argue it probably peaked out even before COVID, maybe like 2010 to 2015. So to me, this is more risk going into the system, and the structural direction for the dollar might be lower for a few years. But after what's happened since the beginning of the year, we maybe have seen what we're going to see for a bit. Markets don't move in straight lines. There's a reason to think that maybe we're overdone here somewhat.
Let me pick at something you said earlier and have said repeatedly, which is that when it comes to the reserve currency, there is no alternative.
Mm-hmm.
And that sort of assumes like the next closest is, let's say, a BRICS or something of this nature. But I suppose
it's the euro. The next closest is the euro.
I don't think so. Why isn't gold the next closest?
Because gold is not a sufficiently liquid asset to
but it seems like
global finance.
But it seems like that's what the world is choosing right now. Is it not?
I don't think so. No.
As it diversifies away from the U.S. dollar, it's not. Market participants aren't going, okay, let's denominate more of our trade in euros or in.
They're not denominating
BRICS.
their trade in gold though either.
Yeah, they are.
They're not really. No,
more trade is getting settled. Yes, it is.
You're only seeing that in the Russia-China
yeah, but that's more than
theater. But the reason
happening
you're
in the
seeing
past.
it there is because of sanctions. This is not a consequential development.
In your opinion, and I'm asking why? Because my point is that as the world diversifies, it's clearly choosing gold as the diversification aspect. It's choosing this. And we've always had these conversations, and the conversations always put the dollar against all of these other currencies. But it seems like the answer is staring at us in the face. It's gold.
I don't think it's the answer, and I don't think that's what they're doing. So again,
break it down.
I am not interpreting China's rabid buying of gold as a market, but it is. But it is, because when you look at the speed with which the gold reserves in China are growing, it's off the charts as relative to anything else.
They're the biggest buyer. They are not the only one.
Oh, it's not even close. And by the way, every other major set of gold reserves hasn't been growing in recent years. All the other big holders, like Japan, say. So you're not really seeing it like that, at that kind of a scale, unless you look at China. And in China, in fairness, in recent years, it has been huge. But that's a geopolitical bet by one country. That's not the market voting. So we do have, certainly, some countries riding China's coattails. We do have, certainly, as I said, a shift away from the US dollar and towards gold, just because you're looking at a world that is less globalized and therefore riskier inherently. So again, there is movement within the extremes where the dollar can be more in favor or less in favor. But the notion that gold, with its, to call it illiquid relative to the US dollar is, it's almost not fair to even make the comparison. To say that you can finance the kind of volumes that the dollar does every day, that you have enough gold above ground to not create a disinflationary collapse were you to tie that amount of volume of transaction to gold, it's like very cruel humor to consider. There is not enough gold in the world if you melted everybody's dentures to create enough supply that you could backstop financing global trade in terms of gold. So yes, it's eaten into the dollar's dominance a bit, and the dollar's dominance probably diminishes further and goes from, let's say, 88% of global monetary transactions in the latest BIS numbers to the ones updated this year, probably down a little bit, probably somewhere in the direction of the low 80s, maybe even dipping into the 70s. That's a meaningful thing. That's trillions and trillions of dollars in difference. But also, nobody is dethroning the dollar. These are moves incrementally within the spectrum of dollar dominance. 5-10% monetary transaction market share. We're not talking about anything that, like, the gap between the dollar and anything else in terms of liquidity is so vast that all of this tinkering at the margins is an afterthought.
Is an afterthought. Okay.
In sort of grand terms. I'm bullish gold, by the way. That doesn't mean that you don't have incremental changes that are a tradable thing. I'm broadly bearish dollars, even though I'm tactically long. I'm broadly.
Can I ask you why does one buy gold?
Two, maybe.
Why
or three.
Why does one buy gold, Ilya? What's the purpose?
To me, the most consistently logical reason to buy gold is not unlike what would be a bet on the dollar, not unlike what would be a bet on the yen, not unlike what would be a bet on the bond. It is a bet on interest rates.
Not an individual. I'm saying, like, why does a nation state hold gold? Why would
mostly
why does China double its gold holdings? Why does India increase its gold holdings?
Mostly
it's just legacy.
For historical legacy reasons. Mostly.
Okay.
And look, if you're the kind of country,
I hold gold just because I've always done it. That's your point. So do you think China doubled its gold holdings just because that they did?
No.
I think Russia quadrupled their gold holdings just because? You think India increased by 500
Russia invaded Ukraine, got cut out of the dollar-based financial system, has to finance their war machine somehow, went to China and said, we're going to trade with you primarily because you don't have a dog in this fight ideologically. You just want to do business. So let's do business.
So in other words, it's a dollar alternative.
In a very narrow, tiny relationship. Russia's economy is not even the size of the state of California.
I'm aware. But
this
in fairness,
we're
California,
not talking about
California's economy is like the 5th largest of all nations, so is it not?
I mean, look at Russia's GDP. This is not, we're not talking about anything that eats into, again, within the parameters of a range. This is not a binary thing. It's not we're going to gold versus dollars or we're going to dollars versus gold.
No, you're the only one making it binary. You're the only one. I've just repeatedly said, right? I'm bearish dollars broadly in this environment, even though I'm long, because again, I think there's a tactical thing where the market is overcooked. But I've been bearish all year. I intend to get bearish again once there's a correction. I'm broadly bullish gold, right? I've said that a few times now. So there's a gradient here with it, but does this threaten the dollar's dominance over everything else? Well, if you think that moving from, let's say, again, almost 90% of global monetary transactions to, let's say, again,
around 80,
your argument
makes
it binary. You're saying it's not binary, and then you make an argument that creates binary. So if you imagine that there's a spectrum of risk, and that the tail risk,
it's not a spectrum of risk.
What is it?
It's a spectrum of how
all risk is
how
is
much
a
of the global. It's a spectrum for how much of the global monetary transaction pie is taken up by the dollar.
No. You're misunderstanding.
The dollar's share
You're misunderstanding, Ilya. Let me finish.
Is not debatable in my mind.
Okay. Just because you keep saying the same point, you don't let me finish mine, doesn't make you right. So there is a spectrum of risk on why you use on all assets. So in the dollar, for example, you have a spectrum of risk. At least that's how we model out everything. Because it doesn't make it right, but like this is our best model, our best way of thinking about the world is through distribution, and the tail risk of in the distribution for utilizing the U.S. dollar for all purposes, it increased. The tail risk increased, so market participants are diversifying away from that tail risk. And they're doing so with several different assets, Bitcoin being one, gold being another. Doesn't seem like silver's really made for this moment, at least.
No.
So it is not binary. I am not saying that gold is now the new reserve currency. What I'm saying is people are diversifying away from the existing one because of the risk. And you gave an example in Russia that proves my point. That you remove them from the dollar system, so they are utilizing their next best option, which is gold, to facilitate some, not all, aspects of their trade. And so my point to you is that the second best option behind the dollar is gold. It's not BRICS, not Euro, it's not any of these things. And the market is proving that. The choices that market participants are choosing right now, it's bearing that out. Like, there's a reason that China doubled their gold holdings since 2020. There's a reason that Russia, in part because of what you just said, quadrupled it. Same with India.
With that idea.
All
What
right,
I
bring
am
it down.
not disagreeing with is that the market is diversifying along a spectrum from the U.S. dollar. Clearly, the dollar's been falling all year. There's a reason why it's been falling. So, if the markets were not exiting some amount of dollar exposure, that would not be going on. Clearly, the price is saying that. The question is, do you consider the economic decisions of two actors under sanctions and under duress that might have made a different decision were they not under duress? We don't know. But what you see is and really only one actor, because Russia just came to China and said, won't you please transact with us? And China saw that they could make some money and buy some oil for pennies on the dollar and some nat gas. So, and okay, fine. But to suggest that what this is the markets voting to say that gold is the next best alternative to financing commerce, I don't sign up to that idea. I think what you have is...
I just say to finance. Go ahead.
I mean, what is what are we saying when we say we're diversifying from the dollar and gold is the next best alternative? You're saying, and again, correct me if I'm wrong, but it sounds like what you're saying is that the markets are voting for gold as the alternative to trade finance to the dollar, not to overtake it, because I think we agree that it's not going to overtake it, and nothing is, not in any kind of forecastable, tradable way. I mean, eventually, maybe, but we're talking in an impractical way from a trading perspective when we talk about eventually. In a practical trading way, there is nothing that is going to overtake the dollar that is discernible here.
Nobody said that, Ilya.
But it
you
sounds
keep
like what you're
extrapolating
saying,
it out to that.
Right. So it sounds like what you're saying is that people are saying the alternative to the dollar losing some ground here is to finance economic activity in gold. And I think that is not what the market is saying.
To store value in gold.
I mean, I think there is certainly a greater appeal to store value in gold in this environment. That's not the same as you looking at gold as a kind of trade financing vehicle, which is why China is buying it, to lubricate its commerce with Russia. That's, I think, a completely different calculus entirely.
I agree.
But I think as a store of value, this has nothing to do with those actors' opinion and a need for them to have a non-dollar based way to transact in order to look at gold and say, if the Fed is going to keep pushing out rate cuts and you're going to get less of a yield advantage on dollars, gold as a store of value in that environment is a natural alternative. But that's a whole other thing. I'm bullish gold for that reason, because I think rate cuts are coming. And I think that makes the dollar less attractive as a yield-bearing instrument. And gold, historically, is a creature of yields, which is what we said at the onset of this conversation. That is nothing like a challenge to the dollar's dominance in global commerce, or the reason that China and Russia are doing what they're doing.
Yeah. I guess it's your frame. It's impossible to break the frame because you're acknowledging that people are diversifying away from the thing, but then you're also saying that it's not a challenge to the thing. But both of those things in my world, in my mind, along the risk spectrum can't be true.
Well, I think dominance is the key. Does it challenge the dominance of the dollar? No. Does it eat into the dominance of the dollar?
You just put yourself in
Yes.
such a small box, man. Nobody said any of these words, and then you protect your position with it smaller and smaller and smaller and smaller.
Oh,
which
absolutely.
Is,
They've
does
said it.
gold
We've spent a year talking
challenge
about how
the
the BRICS are going
dominance
to
of the
take over
dollar?
from the dollar in global commerce.
Who said
China
that?
is.
You're saying I
I've
said
only
that?
been. You didn't say that, but it's certainly a zeitgeist.
I totally
conversation.
agree. I think it's bullshit, and you and I have always agreed it's bullshit.
No. And this is what I mean when I say gold doesn't challenge the dollar's dominance. Maybe this will clarify it. It challenges the degree of the dominance.
Here's my whole point in bringing this up. My whole point is you and I have had that BRICS discussion, and we've always agreed that there is no real imminent challenge or threat. I take it a little bit more. I think I give it a little bit more weight, a little bit more credibility, a little bit more of a long-term threat than I think you do. But I think we both agree there is no. The way people talk about it in today's terms is crazy. What I'm also saying is when we've had that discussion, we never really talked about gold as an option. And I know it's not a thing that you're going to lubricate trade other than a couple of instances, like the Russia-China example. However, it is very clear to me that people are choosing to diversify away from some aspects of the U.S. financial system, and gold is the preferred diversifier at this time, with Bitcoin maybe a distant, I don't want to call it distant second. There's probably a lot of other things before Bitcoin, but it's out there as well. So I wanted to rehash this conversation with you and throw gold in the mix because we had never done it before. It had always been this and BRICS isn't close, so this isn't a worthwhile discussion. And the thing, gold is staring at us right in the face, and I don't know why I never brought it up as sort of an additional layer or component to the conversation that you and I have had many times in the past and have largely agreed on many times in the past. And in that context, I think gold is a much more serious challenge in that people can choose, and they can choose to walk away from I don't want to say walk away from the U.S. dollar. They can choose alternatives to the U.S. dollar to store value, and even in some cases, to lubricate trade. And it's a much more serious, I don't want to call it threat, because that's not the direction of the conversation I want to go, which is we're all going to go use the, gold. We're going to switch over to gold. That's not the conversation I'm having. I'm just saying market participants are voting with their money and they're diversifying away from the dollar, and their first choice is gold.
I think where I agree with you completely is if you want to talk about it in terms of store of value. Where I step back is in terms of the trade finance element.
Yes, I agree.
And so when we frame the conversation of, we've talked about this in terms of BRICS, we've talked about this in terms of this, what about gold? The conversation is, well, the BRICS are going to challenge the dollar's role in global commerce. Gold doesn't challenge even the euro in global commerce because it's not liquid enough. It's not fungible enough. It doesn't challenge the yen in global commerce. Because again, it only exists where Russia, or at scale, where Russia and China have been forced to make it at scale. to basically backstop Russia from accumulating endless amount of yuan that China has locked on shore and basically can do whatever with. It creates something of a global outlet in that. And you want to talk about store of value, I think you're absolutely right. Absolutely right. Of course they've been diversifying into gold as the store of value. I don't think the store of value component takes you in a critical direction on the dollar, because most of the dollar's backstop is that it is unshakably the dominant unit of commercial exchange, although it'll probably take a hit on how much of that commercial exchange is going through the dollar. It's probably not going to stay up at 88, 89. It might go down, and has been lower. It's been in, let's say, the upper 60s, lower 70s, not that long ago, because the euro had a bigger chunk before the Eurozone debt crisis. There was more confidence in the euro. It's given up a lot of that share. So it's not like the dollar hasn't been at a lower share of the transactional pie. It's been there, and like still in the era of sort of post-Volcker dollar dominance, there's a gradient. So I think in terms of investor store of value, those decisions, even central bank reserves, of course, of course, I don't disagree with that at all. I just don't think that when you frame it with the conversation of
You're right.
the dollar is
100%
getting
right.
challenged transactionally, that these are the same things or exist at even comparable scales.
I didn't say it like that, but I framed it with alongside of BRICS, and that had a bunch of assumptions built into the framing of the question. I agree with you 100%.
It's a different anti-dollar argument.
I agree with everything you just said.
I think you and I agree on that one.
100%, and you just landed the plane beautifully. So let's end this with a sort of a fun question. If you were going to pick a new reserve currency based on one of two things, either the name of the currency or the style of its paper design, which one would you pick? And you can't say dollar.
I think there is a very, very strong argument to be made for the yen just because it looks very cool.
Oh, it's so sick. It's so sick.
It looks very, very cool. I think it's not the euro, if only because of the different size notes, which is just ridiculous. Like the larger denomination notes don't fit in a wallet.
I hate that.
What is that? So I think the Indonesian rupiah is a very cool looking currency also. It's got a ton of zeros on it, which kind of, creates some drama and defect. The only time I've been I've been a millionaire is when I went to Bali and became a rupiah millionaire. So that's one. But I think the yen would be a cool one. I think the yen is a very cool looking currency.
I agree. That would be on design. It would be the yen. On name, it would be the what is it? The Vietnamese dong. I think that's because I'm a 12-year-old at heart.
That's a good one. Although the Kenyan shilling is a cool name. Like that just rolls off the tongue. Nice.
That's not bad. Ilya Spivak, I always enjoy these conversations. You're always a gentleman, allowing me to scrape together two brain cells and try to have a go at you. At least do my best.
He's nothing if not self-deprecating. Folks. Don't let him fool you.
If people want more from you, and they should, tell them where they can go.
As ever, I'm commenting at Ilya Spivak on the former Twitter and on Blue Sky. I'm all over the PM schedule on Tasty Live. We got overtime. We got this show. We got macro money. So all over the place. Oh, and I'm writing for tastylive.com as well 4 times a week. So if all of this talking from my face is too much, you can read it all in abridged written format.
I say it all the time. I think it's hard to say this because I might get some people mad at me. I think you have one of the best shows on the network, man. It's 30 minutes of super concise, well-delivered information, mostly unbiased.
I appreciate it. Thank you.
Mostly. And I think
it's only biased through what I'm long or short at that moment in time. That's the bias. It's like, have I talked myself into buying or selling anything yet?
And I think you're a terrific writer as well. So anyone that's not reading Ilya's stuff is missing out, in my personal point of view. If you want to read any of my craziness, you can find me on Twitter at Victor Jones. Owen Jones is 0 because I like to be difficult. Thank you very much, Ilya, as a gentleman and a scholar here. Thanks, everybody watching. Hit the like button before you get out of here. Subscribe to the channel. Go find Ilya on Twitter and Blue Sky. And I will see you back here tomorrow, same time, same place, same great network, all in Tasty Live. Peace.
Peace.